for this session in order to discuss the mock paper that you sat on a few days back. So I hope you had gone through the mock paper and you had attempted the mock paper, right? Which was quite similar to the pilot paper, right? So I thought of taking this time, another 3 to 4 hours, to take you through and to refresh your memory relating to the areas which has been tested in the mock examination. So first of all, before we discuss the questions, my dear students, we need to uh, have an understanding when compared with the previous syllabus paper. There's a structural difference. So earlier we had MCQs, but now there are no MCQs, right? Instead, we have two sections. Section A, you will have 5 10-mark questions which are short scenario based questions, and then section B will consist of 3 questions, 6, 7 and 8. Out of that 3, you will have to select 2 questions, right? You will have to select 2 questions and answer 25 marks each. Therefore, you will be having a selection, right? You have to select 2 out of 3, which that privilege is not there in the previous syllabus. Anyway, when you get the paper, you have to write the entire question paper. But now, you have to select 2 out of 3 questions. Therefore, you will have to plan well when attempting the paper, right? You will have to plan well when attempting the paper. You will be required to think and clearly identify these are the questions that I am going to attempt, right? So that precision need to be there from your end when you are attempting this examination, right? So having said that, right, having said that, let's start our discussion. So it's from question 1. Now since we will be having a lengthy session, I will be taking some 5 minutes or breaks between some questions. So in order to make myself refreshed and also you also to get yourself refreshed. So till then, let's continue. Right. Right. So right. So let's start discussion. So guys, there's a heavy rain here. I don't know. Sometimes there might be connection difficulties, right? There's a heavy rain. So it might be the reasons. Paper is already shared in the chat also, and I guess it was being circulated via email. So you can open it. Then no need to worry on the clearness, right? So let's start with question number 1. Let's first see the requirement. We have to outline 3 types of sustainability related financial information that Highland Leaf would be required to disclose under SLFRS S1. Then you have to explain the meaning of materiality in the context of sustainability related financial disclosures under SLFRS S1. Then you are required to analyze how Highland Leaf should determine the material information that should be disclosed with respect to the sustainability related risk and opportunities in accordance with SLFRS S1 and S2 using the facts provided above in the scenario. Right. So let's start from the first one. We have to outline three sustainability related financial information that should be required to disclose under SLFRS S1. My dear students, now as per SLFRS S1 and S2, the sustainability reporting standards, there are four key pillars that you are required to disclose. So what are that four key pillars? Starting from the governance, right? Starting from the governance, we have to disclose strategy, then risk management, then metrics and targets. Metrics and targets. So governance, strategy, risk management, metrics and targets are the general requirement of four elements relating to S1 and S2. So SLFRS S1, you know, is relating to general sustainability related risk and opportunities, SRROs, where SLFRS S2, the climate related disclosure standard, is focusing on climate related risk and opportunities, CRROs, right? So it is SRROs and CRROs. So S1 focus on SRROs, S2 focus on CRROs. So in both S1 and S2, the requirement is to disclose governance information, strategy information, risk management information, and metrics and targets. Now, the examiner's requirement is not to write this four as it is. He is asking how or is outline three types of sustainability related information that Highland Leaf would be required to disclose. So you are required to relate it to the Highland Leaf scenario. So when we are relating it to the Highland Leaf scenario, what are the points that we can say? We have to read the scenario. Let's go and see. Highland Leaf Plantations PLC is the listed Sri Lankan producer and exporter of black tea, right? A listed Sri Lankan producer and exporter of black tea and sheet rubber, supplying premium retail brands in Europe and Middle East. The company operates 4 estates in the Central Highlands and 1 rubber estate in the wet zone. Highland Leaf is preparing its first sustainability related financial disclosures in accordance with SLFRS S1. During the reporting period, let's see. During the reporting period, several European buyers requested documented evidence of reductions in agrochemical use and carbon emissions per kilogram of made tea. So they have requested the documented evidence of reduction in agrochemical. An extended drought reduced estate yields and board acknowledged growing exposure to physical climate risk affecting the future harvest. Okay, so they are exposed to physical climate risk, then the board has acknowledged the growing physical risk will increase the exposure. A rooftop solar power facility was commissioned at the main factory at cost of 95 million. The company's largest buyer, accounting for 32% of annual revenue, warned the failure to comply with European sustainability and deforestation regulations could result in delisting from its approved supplier panel. Then next one, worker representatives raised concerns over the condition of estate line housing and access to clean water. Right. So there are few items now, few issues, few sustainability related risk and mainly the risk have been outlined in this scenario. Now, with regard to these things, what are the sustainability related information the Highland Leaf would require to disclose? Okay. So starting from the governance, Highland Leaf should disclose how the board of directors involvement, the governing body of the organization, those charged with governance is the board of directors. So the board of directors involvement in identifying those sustainability related risks and managing and disclosing them in financial statements. So how the board of directors are going to discharge their responsibilities relating to the what? Relating to the sustainability related risk and opportunities that you will have to disclose. The first point then, the governance related information, especially how the board of directors oversight will work on identifying, managing and disclosing the sustainability related risk and opportunities. That's the first one. Then second, strategy. So organizations will have short term, medium term and long term organizational strategies. The point is, the organization is required to incorporate the sustainability and climate related measures, sustainability related risk and opportunities that we identified and their effects into the organizational strategy. So that thing need to be disclosed. Now for example, in this scenario there is I said that the largest buyer is requesting, right, the largest buyer has warned, and if the organization failed to comply with the new European sustainability standards, they will remove us from the approved supplier list. They are removing us from the approved supplier list. Why? Because we do not comply with the sustainability related guidelines. And then again at the same time, the very first point here, right, very first point here, the buyers has requested documented evidence relating to the carbon emission. So based on these items, what is our organizational strategy, how these sustainability related risk and opportunities are embedded to the organizational short term, medium term and long term strategy. So that thing they need to disclose. Then risk management information, they are required to disclose what are the available processes to identify, assess, prioritize and manage. So first of all they need to identify, then they need to assess the impact. Based on the assessed impact, they need to prioritize. After prioritizing, they need to manage and disclose these facts. So how those things are done and what are the available processes for that risk management, Highland Leaf should disclose. So that is under risk management. Then again for the metrics and targets, they can disclose what? How they are going to measure the carbon emission. How they are, the metrics means that how they are going to measure the carbon emission, how they are going to measure the quality of the workers' houses, the line housing, how they are going to measure the quality. So that is the metric. And the target, by next year or next 5 years or next 10 years time, what is the targeted level of achievement in those said metrics, right, in those said metrics. So that is what the other thing that they have to disclose, right. Okay, so the first question is done. So that's what we have to disclose. Explain the concept of materiality. So we have to explain the concept of materiality. Now in IFRS or SLFRS S1, this materiality means what? What are the information that the capital market providers or the main stakeholders who are providing funds to the organization will think that is material. So in case if we omit any item, right, omission or not presenting or presenting false information, if such thing can change the decision of a stakeholder, that information is material. So in this concept, right, in information about, now S1 no, information about sustainability related risk and opportunities that could make a change in the decision of a capital market provider, right? A capital market provider who are the primary users of general purpose financial information, who are the primary users of general purpose financial information shall be disclosed. ඕක තමයි materiality කියලා කියන්නේ. මොකක්ද එහෙනම් materiality කියලා කියන්නේ? What does it mean by materiality? If any item omitted or falsely presented, if that item can make a change in the decisions of the primary users of the general purpose financial statements, that item is material. When we relate that to the sustainability, any sustainability related risk and opportunity related information that can make a change in the decisions of primary users, that information is material, right? That's how you are required to explain the meaning of materiality. That's how you need to explain the meaning of materiality. So that would be entity specific. හැම entity එකකම all entities will not have the same type of SRROs and same type of sustainability information. So that depends on entity and that depends on each and every entity's primary stakeholders' thoughts, right? Therefore, we will have to assess that. Then next one, analyze how Highland Leaf should determine the material information that should be disclosed with respect to sustainability related risk and opportunities in accordance with S1 and S2. Okay, so we have to analyze how the Highland Leaf should determine the material information. Now, I told you how this material information need to be identified. For example, what does it mean by materiality? If any decision can be influenced. Harini, that's the point, right? So, first of all, what we have to do? We will have to assess the impact, right? We will have to assess the impact. When assessing this impact, we will have to consider the magnitude of the risk, likelihood of the risk, right? Magnitude of the risk, likelihood of the risk, then the strategic relevance of the risk, how this risk and opportunities can strategically relevant to the organization. So strategic relevance of the risk. Then the potential impact on cash flows, and then the potential impact on cash flows, and then the potential impact on cash flows. So we are required to assess the impact first based on these magnitude, likelihood, strategic relevance and potential impact on cash flows. So after assessing the impact, we will have to identify based on this what are the material items. What are the material items? So then we have to disclose these material items. Now in the given scenario, what are the available material items? Material means items that can influence the decisions of the primary user. So මොනවාද මෙතන තියෙන්නේ වගේ, right? From these items, what are the things that can influence the decisions of primary users? Here, several European buyers requested documented evidence. So customers requesting documented evidence would be an information, right? Would be an information that will directly affect the foreign customers, right? So that information will be required and that information will be leading, right? That information will be leading to potential loss, right? Potential loss of our foreign customers. So losing that foreign customers will definitely affect the cash flows of the entity. So customers requesting the documented evidence, right? The customers requesting the documented evidence would be a significant disclosure, right? Why? Because losing those foreign customers will highly, massively impact our cash flows. So that may be one item. But our point is, we are telling, okay, you need to assess as the management whether this is material or not. Then another one, this the extended drought reduced the yields and the board acknowledged growing exposure to physical climate risk. So the extended drought reduced the estate yields. This would be a material disclosure. Why? Board is acknowledging that in future also this type of drought can be continued, right? This type of drought can be continued, and when the drought is being continued, right, when the drought is being continued, it will be continuously affecting the cash flows of the organization, right? It will be continuously affecting the cash flows of the organization. Therefore, considering that if this thing happen, it will have a massive impact. Sometimes the likelihood of the risk is low, but if the event happens, it will do a massive impact. So based on that matrix, we have to assess. Now once we assess that, this might be a significant item that would require a disclosure. So you will have to think on disclosing this fact, right? Then another one here, rooftop solar power facility was commissioned at the main factory. So they have done a massive capital investment. It's a 95 million investment. So we may disclose this information to the stakeholders to say this is the ESG related capital investment. We have done this much of investment for the sustainability related things. Therefore, this solar power is what? The solar power is a sustainable power generation method. So investing 95 million for this is really an important information to the stakeholders. Why? Then they, by looking at the disclosure, they think, okay, this organization is kind of good. Why? They are concerning on the environment. So end of the day, this non-financial reporting will improve the brand reputation. So this information in that point of view will be a good point. Why? It's a massive investment. So they have invested a significant amount on this, right? Then another one, right? Another information, this one, the company's largest buyer, right? The company's largest buyer. So accounting for 32% of annual revenue. That warning will be a required or material disclosure. Why? If we fail to comply that, we are having a risk of losing 32% of annual revenue. Guys, losing 32% of annual revenue is not a small thing. It's never a small thing. Therefore, this, considering the magnitude, likelihood, impact to the cash flows, all this stuff, this will be, or this may be a material disclosure. So these four things we may disclose here. අපි ඔන්න ඔය දේවල් ගැන අපිට disclose කරන්න පුළුවන් කියලායි කියන්නේ, right? Disclose කරන්න පුළුවන් කියලායි කියන්නේ. Why? Based on what? Considering the magnitude, likelihood, strategic relevance and potential impact on cash flows. In addition to that, here, number 5, in addition to that, workers have raised concern over the condition of the estate line housing. This might also be a significant information. Why? Because in case if the workers start protesting, then it will be temporarily halting the organization's activities. So temporarily halting organization's activities will lead to reduced cash flows. It will lead to reduced cash flows. So when those cash flows are reduced, it will directly affect into the bottom line of the organization for which the primary users are focused on. So This would be again a material disclosure. Therefore, when you are writing the answer, you may highlight this fact, right? You may highlight these facts because those things need to be assessed and those things are required to be disclosed based on the magnitude, likelihood, strategic relevance and potential impact on cash flows. Potential impact on cash flows. So that should be the answer. That should be the answer, right? Okay. So this is the discussion. So after a while, not today, after a while, I might be able to share a sample answer for the theoretical area, not for the calculations, for the theoretical areas, because I am not giving an answer to write at this moment, considering the relevance of time. So I might be able to share the answer sheet for the theoretical questions. So you may receive it as a circulation by the CA Sri Lanka team. Okay. So don't worry on that. First, in this session, put those things into your mind. Put the concepts into your mind and have that understanding. Okay. Now let's move on to question number 2. Let's see the requirement first. Required outline how audit committee should discharge its independent review responsibilities over the year-end financial statements of Pearl Ceramics with particular emphasis on areas of heightened risk arising from liquidity pressures and reliance on external financing. So, my dear students, now when we say how the audit committee should discharge their independent review responsibilities, right? The audit committee is what? First, we have to know that audit committee is a subcommittee of board of directors. Audit committee is a subcommittee of board of directors, right? It is a subcommittee of board of directors comprising of comprising of independent non-executive directors primarily, right? Because audit committee should be an independent organization. I mean, not a legal entity, but it should be a subcommittee comprising of independent people, independent directors. Therefore, subcommittee of the board of directors, which is the audit committee, should be comprised of independent non-executive directors. Otherwise, they will not be able to, right? Otherwise, they will not be able to discharge their responsibilities as required level. Why? When you are an employee of that organization, you will be having a second thought of what? Challenging the things. But when you are independent, you are not worried. You do not have any interest. Only interest is to act on good faith for the benefit of the shareholders. Therefore, at that point, when you are independent, you will raise the questions when and where necessary. Right? So it will be easy to discharge the responsibilities. Therefore, sorry. When the audit committee is going to discharge their responsibilities, being independent is important. So as the first thing, you have to put that point into your mind. Now let's read the scenario and see how they need to be mindful and on what they need to discharge their responsibilities on reviewing. Pearl Ceramic is a medium-sized Sri Lankan manufacturer of tableware, supplying local hotels and export markets. The company is currently experiencing tightened cash flows, rising energy cost and increasing reliance on its bank overdraft facility and short-term borrowings. As a result, suppliers have reduced credit terms and the main bank has requested updated, credible and reliable financial information before deciding on the renewal of its financing facilities. So, the main bank is requesting updated, credible and reliable financial information. Why they are requesting updated, credible and other related information? Because the bank is not sure, right? Because the bank is not sure whether the company will manipulate those financial statements. To maintain the facility, the bank is not sure that they will manipulate and give created, right, cooked or crafted financial statements rather than the correct one, right, rather than the correct one. So that risk is there. Having that risk, bank has requested audited financial statements. In response to these pressures, the board of directors has emphasized the importance of strong corporate governance over the financial reporting process. In particular, the board has tasked the audit committee, which is required to operate independently of management with overseeing the integrity of financial statements, significant accounting judgments, and compliance with accounting standards. As part of the year-end financial reporting process, Pearl Ceramics must determine the fair value of a coastal plot of land. Hari. This part is something else, right? That part is something else. Let's discuss it later. Now, based on the given information, at the moment, Pearl Ceramic is facing significant financial difficulties. Therefore, bank has requested to provide, right? Bank has requested to provide updated audited financial statements, right? Credible and reliable financial information. Now, as the audit committee, they have a responsibility of what? Right? They have a responsibility of what? Why the bank is worried on? Why the bank is worried on? Bank is worried because they are continuously taking loans, and if they were not able to settle this loan, the company might be in a going concern issue, right? Company might be in a going concern issue. So as the audit committee, right? As the audit committee should discharge their responsibilities firstly, right? Firstly, by doing what? Number one, they need to, right, check the going concern, or else they need to assess the going concern. They need to assess going concern. So assessing the going concern, I mean reviewing the going concern means they need to get the cash flow forecast from the management. They need to get the cash flow forecast from the management, and after getting those, they will have to check whether the inputs are okay, whether those judgments are reasonable use for the forecast, and then whether the adequate disclosures have been made to the financial statements. Why? Because bank is requesting credible and reliable information. So with regard to the going concern, audit committee must check whether sufficient disclosures have been made in the financial statements or not. Then, in addition, right, they need to provide their oversight, right? They need to provide their oversight on internal controls over financial reporting. They need to provide oversight on internal controls over financial reporting. Why? Because when the internal controls over financial reporting are not in place, then the output from such internal control system, such financial reporting system, will be again not reliable, right? When there are no sound internal control systems, the output from such system, which is the financial statements, are not reliable. Okay. So they need to provide the oversight on internal controls or financial reporting. Then they need to oversee, right? They need to oversee, and they need to review, right? Oversee and review information provided to external parties. Information provided to external parties. Now, the problem is here, Mebaran, they are currently experiencing tightened cash flows, rise in energy cost. So, when this type of a scenario is happening in an organization, there is a high risk of FS manipulations. That's what I told you. And the organization might communicate to the outsiders something that is not real, right? Yes, in-house we are facing troubles, but when we are doing the communication to the external parties, we are the best, right? We are the best. So that can be happen. Always the financial information and other information that we provide should be transparent. Assessing whether those are correct which are communicated to the third party is a responsibility. I mean, not all the information, but the critical material information should be overseas and should be reviewed by the audit committee. That is one way that audit committee can discharge their responsibilities uh, in this hectic scenario, right? The organization is facing troubles. Then again, right? Then again, audit committee's another responsibility is to interact with external auditors. Interact with external auditors. Interact with external auditors. So, as the audit committee, they need to interact with external auditors and they need to ask, right? They need to ask, they need to communicate and identify the audit plan of the organization. That means external auditors plan to conduct the audit. What are the findings, right? So there's a separate auditing standard stating that the matters required to be communicated to those charged with governance. So whether there are any such information, right? Whether there are any such information. So whether the external auditors has obtained sufficient and appropriate audit evidence when providing the opinion. So those things are required to be checked. So interacting with external auditors. Then finally, they need to do all of this stuff, they need to maintain the independence. They need to maintain the independence. Regularly, they are required to evaluate whether any threats to independence are present or not, right? Any threats to independence are present or not. Then again, audit committee need to be mindful on the reputational risks that can happen to the organization, right? So those things are the ways that audit committee can discharge their responsibilities, right? So how the audit committee can discharge their responsibilities? So it's for 5 marks. Now when it is to outline, you may write it in single bullet points, right? So no need of lengthy answers. Then second part of this question, analyze the reasonableness of the valuer's application of the highest and best use principle in determining the fair value of pearl ceramics coastal land in accordance with SLFRS 13 fair value measurement. Now my dear students, if we quickly recall our memory, right? If we quickly recall our memory on SLFRS 13, right? This SLFRS 13 is based on the fair value measurement. This fair value can be measured of both financial assets and of non-financial assets. When we are thinking only on the asset angle, right? Just let's see in the point of view of an asset. It's not only for assets, but if we think in the point of view of an asset, the fair value measurement can be done for financial assets and non-financial asset. So especially when we are measuring the fair value of non-financial asset, when we are assessing the fair value of the non-financial asset, right, this fair value measurement should be based on highest and best use. This should be based on highest and best use. So highest and best use means, right, what is the out of alternative options. Let's say we have a land. That land can be either used for commercial purposes or for residential purposes. We can build a house and live inside that, or else we can create a factory and start a business, right? So for a non-financial asset, there can be alternative uses. Out of those alternative uses, what is the use that give you, right? What is the use that give you the maximum possible benefit, maximum possible value, right, for that non-financial asset? Then when assessing this highest and best use, right, when assessing this highest and best use, existing use, right, existing use is not need to be mandatorily the highest and best use, right, but we have a presumption. The presumption is existing use is the, right, existing use is the highest and best use. So we have a presumption that existing use is the highest and best use, but that's not the case. That's not the case. ඒක mandatory කියලා නැහැ. But we have a presumption. Then again, when we are assessing this highest and best use, right? When we are assessing this highest and best use, we have to think on three things. We have to think on three things. Number one, right? Whether it is physically possible. Whether it is physically possible. Now, just think, there's a small plot of land in front of Gangarame temple. Right? Now, when we are valuing the fair value of that property, right? Let's say we are assuming, we are checking the alternative available uses, right? We are checking the available alternative uses. One is to keep the bare land like that and to use it as a car park. Or else we can develop it to a casino. It's in the central heart of Colombo. So even the foreigners are visiting the temple. So we might start up a casino, right? So thinking that in that premises it is physically possible. Why? The space is enough, the ease of access is there, physically puluwanda, right? Physically possible. Then we need to check whether it is legally permissible. Legally permissible. Now you think, even though it is physically possible to put up a casino in front of Gangarame temple, will it be allowed by the law? What do you think? What do you think? Put into the chat. Now it is physically possible, yes, we know, ease of access. But will the law permit us to put up a casino in front of Gangarame temple? Never. So, no legally possible, right? It's not legally possible. Sorry, not legally possible, not legally permissible. I made a mistake. Not legally permissible. Then, third aspect we have to check is whether it is financially feasible. Whether it is financially feasible. Then we will have to do a project evaluation and check, by putting up a casino in front of Gangarame temple, whether I can generate a good net cash flow, whether NPV is positive, whether I can create a positive value to the organization, So these three aspects need to be considered when we are deciding the highest and best use of a non-financial asset, right? Now, having this understanding, if you want, you can take a screenshot of this. Sorry, now you can take a screenshot if you want. So, having this understanding, now let's go and read the question. right? Okay, now let's see. Abi gihilla balamu. As a part of the year-end financial reporting process, Pearl Ceramics must determine the fair value of a coastal plot of land acquired 12 years ago. The land is located in a zone that current law is designated for agricultural land, agricultural and light industrial use only. Tourism and hotel development on the plot is expressly prohibited and would not granted approval by the relevant authority. However, the external valuer's current fair value estimate assumes that the land could be developed into a beachfront hotel based on the rapid tourism growth in the surrounding coastal belt. Management is inclined to accept this higher valuation given the company's strained financial position. The audit committee, however, has raised concerns about whether this valuation approach complies with SLFRS 13 fair value measurement, particularly the principles relating to market-based assumptions and highest and best use, and whether accepting such a valuation would undermine transparent and ethical financial reporting. Transparent and ethical financial reporting, right? What do you think? What do you think? ඔයාලට මොකද හිතෙන්නේ? Now I have explained to you, when we are measuring or when you are estimating the fair value based on highest and best use principle, right? Based on highest and best use principle, we have to think on three things. What are the three things? Whether it is physically possible, legally permissible and financially feasible. Now, based on this information, yes, obviously, right? Obviously, building a beach or else beachfront hotel in the coastal area would be one of the physically possible thing. Land එකක් තියෙනවා, so can't we build a hotel? Yes, obviously can. Physically possible. And yes, obviously it will be financially feasible. It would be financially feasible. That's why they have the value has given the value based on the highest and best use, assuming that it can be converted into a hotel. But where the problem comes, what is the hindrance? Tell me, what is the hindrance to the to limit that measuring? Right? What is the hindrance? Okay, drop a message. Exactly. So this is not legally permissible, even though it is financially feasible and even though it is physically possible. This will not be allowed by the what? This will not be allowed by the law. Therefore, when you are writing this answer, right? When you are writing this answer, first thing you need to analyze the reasonableness. How are you going to analyze the reasonableness? First of all, you will write the rule. Rule is what? What I explained. For non-financial assets, obviously we need to get the fair value based on the highest and best use principle. When we are getting the fair value based on highest and best use principle, right? From highest and best use principle, we need to think whether it is physically possible, legally permissible and financially feasible. Then you need to relate that to this scenario. So if I relate this into the scenario, right? If we go to that summary and if I relate it here, how I can relate that? Yes, obviously this is physically possible, this is financially feasible, but it is not legally permissible. since it is not legally permissible, right? Since it is not legally permissible, you need to mention the fact that, right? You need to mention the fact that using highest and best use as the hotel, right? Using highest and best use as the hotel is wrong. Why it is wrong? Because it is not legally permissible. Then in the second part, right? In the second part, they are asking to determine whether the valuation based on commercial redevelopment assumptions should be adopted to the financial reporting purposes. Now they are trying to get the highest value into the books. Why? Because they are facing troubles, financial difficulties. When we get a fair value gain, yes, obviously it will improve the asset base. Obviously it will improve the set base. Therefore my dear students, so first when you analyzing, you write this stuff and you tell it is a clear violation of highest and best use principle in SLFRS 13. Then in the second part you are asked to determine whether the valuation should be adopted. You need to provide a clear cut conclusion. What is that? This valuation shall not be adopted for financial reporting purposes. Why I am telling this shall not be adopted? Because that option is not legally permissible. Because that option is not legally permissible. Right. That is the point. Is it clear? Please drop a message. Is it clear, my dears? Up to now, the things, is it clear? Are you enjoying the session or is it boring? Need a good sleep now. Only 1 week for the exam. Okay. So you will have to utilize this 1 week, right? Someone is enjoying the rain. Obviously here we are also enjoying the rain, and that's why sometimes the connection is dropping. So apologize for that, right? Did we have audit part also for CFR? No, that's only the audit committee that's relating to the overall the regulatory framework. No? So nothing related to audit in this one because we have a separate paper for auditing. Analyze and determines means kind of same answers. No, analyzing in the sense you are applying the theory into the practice, right? You are analyzing what is the requirement, what they have done, can it be done. Then determining means you are giving the conclusion. That's the clear cut conclusion. This valuation shall not be adopted. Why the analysis is above? Based on the above analysis, you are giving the conclusion. That's the determination. Is it clear? Right. Okay. Then let's go for the next question. Right. Okay. So this is on SME, SLFRS for SME. Oh, recording එක දෙනවා. Institute එකෙන් share කරයි එක. Right. අපි බලමු මොකද්ද කියන්නේ කියලා. Determine how the accounting treatment of the following transactions in marinas. Here it is also to determine, right? You have to apply the requirement and give the clear cut determination. මේක තමයි කරන්න ඕන, right? One question is there on audit committee. So I am not clear what you are asking. Can you please elaborate what your requirement is? I am not very clear. I will give the answer in a while, right? So please elaborate your question. Okay. Next point. Determine the accounting treatment of the following transactions based on SLFRS for SME 6 marks. 6 marks. හරි. Points 3ක් තියෙන්නේ. So points 3ක් 6 marks. Now this is SLFRS for SME. You know SLFRS for SME book is open book, right? You can take it to the exam. So I'm not going to refer the answer to the exact section in this session, right? But you can at least here you can at least go to this SLFRS for SME. Sorry, this is not the one. Right? So you can at least go to this SLFRS for SME and you can at least refer here. You have the subtopics, no? You have the sections. You can at least refer to those sections, my dears, when you are writing the answer. If you can't provide the exact paragraph reference, perfectly fine. That's not a mandatory requirement to write the exact requirement or exact paragraph, but if you can at least provide the section reference as per section 25 borrowing cost, right? So ඒ වගේ at least ඔයාලට එහෙම දෙන්න පුළුවන් නම් that would be better, right? That would be better. හරි. Okay, now let's go for this borrowing cost. Okay, first one, borrowing cost. It is section 25, right? It is section 25. Let's read the question. Marina had obtained a specific bank loan, right, at an interest rate of 12% per annum to fund the construction of a new factory premises. As the construction meet the definition of a qualifying asset, the management of Marina is intended to capitalize the borrowing cost. Okay. So, what's the point now? What's the point? Can they recognize this? What's your answer? Just give a hint. What do you think? Can they capitalize? Okay. So, yes, good. Your answers are correct. So, as per SLFRS for SME, there are no capitalizable borrowing costs, right? There are no capitalizable borrowing costs. So, the accounting treatment should be what? The accounting treatment should be to recognize this as an expense. So you may refer, right? You may refer SLFRS for SME section 25, right? As per section 25, borrowing cost, irrespective of whether it is to fund a qualifying asset or not for that purpose, you have to charge it to P&L. You cannot capitalize. That capitalizing option is not available. Right. Then the next one, intangible asset development cost. So now if I quickly really relate this to full SLFRS framework, in the borrowing cost, full SLFRS framework, what does it say? LKS 23 say, if the borrowing cost is on a qualifying asset, yes, we can capitalize the borrowing cost. If the borrowing cost is not on a qualifying asset, then we have to recognize in P&L. That's what the full SLFRS framework say. That's what the full SLFRS framework say. But SLFRS for SME, right? SLFRS for SME do not say, right? SLFRS for SME do not say that qualifying asset borrowing cost can be capitalized. Therefore, it's very easy. Don't think on the type of the borrowing cost, capitalize it. Then development cost is also same. As per LCS 38, the development cost can be capitalized upon meeting the criteria in paragraph 57, right? But in SLFRS for SME, right? SLFRS for SME, let's see what is the section. If I'm not mistaken, it's 18. Yes, it's 18. As per section 18, it need to be recorded in P&L. So as per section 18, the development cost 6.2 million here. The development cost 6.2 million shall be recognized in P&L as an expense. Right? Because no any capitalization is permitted. No any capitalization is permitted. Hari. Goodwill. Now, in full SLFRS framework, goodwill on business acquisition is not amortized, right? No amortization for the goodwill on business acquisition. Instead, what we have to do is to annually mandatorily test for impairment. LKS 36 paragraph 10 says that, right, any goodwill on business acquisition shall be annually mandatorily test for impairment, right? Annually mandatorily test for impairment. Therefore, that's the requirement in full SLFRS. But here, Marina has a goodwill arising from a business combination in previous year. Management intends to perform an annual impairment test. Section 19, right? Section 19 of SLFRS for SME say there is no any mandatory requirement for annual impairment, right? So we are required to amortize, right? We are required to amortize the goodwill over useful lifetime, right? However, this useful lifetime shall not exceed 10 years, right? Useful lifetime shall not exceed 10 years as per the SLFRS for SME. Then, right, then no mandatory annual impairment testing, no mandatory annual impairment testing, and impairment testing will be required only if there are impairment indication, right? Only if there are impairment indication, we are required to perform an annual impairment testing, right? Other than that, no any mandatory requirement. Indication තිබ්බොත් විතරයි නැත්තම් ඕනේ නැහැ. Is it clear? Right. You may refer to these sections and see after the session. So that's the first question. 6 marks. Quite easy, right? 6 marks. Then B. Demonstrate, right? Demonstrate using appropriate figures how the corporate debenture investment should be presented in the financial statements for the year ended 31st March 2025, especially in the income statement and in the statement of financial position. Okay. Right. So, demonstrate using appropriate figures how the corporate debenture investment should be presented in the financial statements. Right. Tell me, as per the financial instrument related guidelines, how these need to be presented. On 1st April 2024, Marina invested in a corporate debenture. Invested in a corporate debenture, right? Invested in a corporate debenture, that means it is a financial asset. The instrument does not contain any complex features. Therefore, management correctly identified that it should be measured at amortized cost. So that it should be measured at amortized cost. Right. Now, my dear students, when we are measuring it at amortized cost, so what is the requirement? So what is the requirement of amortized cost? We will have to take the opening balance, opening carrying amount, right? Then we will have to add interest. This interest is required to be added based on the effective interest rate. Then if there is any payment, we have to reduce the payment. Then we have the closing balance. This is the amortization method. So if there is no any transaction cost, if there is no any maturity premium, right? No any maturity premium, then the effective interest and the nominal interest would be same, right? Effective interest and the nominal interest would be same. But in this question, that's not the case. Why here? There is a broker commission paid, which is a transaction cost, right? No annual interest payments. Instead, there is a maturity value, right? Here there is a maturity value, face value plus face value into 5 years into 8% per annum. 8% per annum, right? The entire maturity value will be received on 31st March 2029. Now, if we recall the memory on effective interest method, right? So, what is this effective interest method? Effective interest method and the effective interest rate. So, in the effective interest method, it does two things. It has two duties. The duty number one is to convert, right? Convert initial recognition value, right? It will convert initial recognition value into final maturity value. Final maturity value. Then number two, right? Then number two, this will, right? This will allocate the effective interest, right? This will allocate the effective interest or the finance charge over term to maturity, over the term to maturity. So these two duties are there with regard to the effective interest method. Therefore, the effective interest rate, right? The effective interest rate we are using in this effective interest method, right? Effective interest rate that we are using in this effective interest method is the discount rate that, right? Is the discount rate that discounts the exact maturity value, right? Exact maturity value, or I would say the future value, right? To the current present value. Other vatinakama initially recognized value. So this present value is the, let's say, initial recognition, right? Initial recognition, and this is the maturity value, right? This is the maturity value MV. Now, once we apply the discounting factor at the discount rate, right? These two would be same, right? These two would be same. So this discount rate that convert the final maturity value into the initial recognition value is the effective interest rate. So the gap between the initially recognized value, right? The initial recognition and the final maturity value, initial recognition and the final maturity value, the gap between these two, right? The gap between these two will be accounted by coupon interest if there is any, right? Will be accounted by coupon interest if there is any. Then if there is any transaction cost, if there is any maturity premium, right? So when there are no any transaction cost or maturity premium, and when there is only coupon interest, the effective interest rate and the coupon interest rate is same. But when there are transaction cost and maturity premium, right, the gap will be increased, therefore effective interest rate should be high. Effective interest rate should be high. Is it clear? Right. Therefore, in the given scenario, there is no coupon interest. In the given scenario, there is no coupon interest, there is a transaction cost, and there is a maturity premium. Why? We are paying something additional than the face value. We are paying something additional than the face value. So we have a maturity premium. Therefore, my dear students, since we have transaction cost and maturity premium, we will have to calculate an effective interest rate. Effective interest rate. Okay. So think in this concept, right? Think in this concept, converting final maturity value into the initial recognition value. The discount rate that do the said stuff is the effective interest rate. So considering this theory, just give it a try. Podi try එකක් දෙන්න බලන්න හදන්න. Try එකක් දෙන්න. I will give you 2 minutes. Right. Okay, I will show the chart to take a screenshot. Okay. So this is the chart. Is it visible? Right. Okay. Yes, ratios තියෙනවා. මේකෙත් ප්‍රශ්නයක් තියෙනවා ratios වලින්. Ratios and the consolidation question, which is question number 7, will be discussed by Sandeep sir on 14th at 7 p.m. The link will be shared with you all. So I'm not going to discuss that question today. So I'm trying my best to cover all other items. Right. Okay. Now let's go back to the question. Let's go back to the question. So here, amount invested 60 million, broker commission paid 1.2, maturity date and no annual interest payment, the maturity value, and the entire maturity value will be received on 31st March 2019. So what is the term to maturity? We have done this investment on 1st April 2024 and it will be matured on 31st March 2029. How many years? How many years? It is 5 years. Term to maturity is 5 years. Hari. Now, having said that, let's first calculate the effective interest and then move on. Right? So, initial recognition value, initial recognition should be the fair value plus transaction cost. Here fair value is the amount that we have invested in this scenario, which is 60 million plus this entire question will be done in rupees millions. 60 million plus the broker commission 1.2 million, which is 61.2 million, which is 61.2 million. Right. So term to maturity we know, term to maturity 5 years, term to maturity 5 years. Then the maturity value, we have to calculate the maturity value. How much is the maturity value? It is face value plus. So 60 plus face value into 5 into 8%. Here then 60 plus 24. It is 84. It is 84. Now here the present value is equal to future value into 1 divided by 1 plus r to the power n. So the present value is 61.2 million and the future value is 84 million into 1 divided by 1 plus r to the power 5. හරිනේ. දැන් අපි මොකද කරන්න ඕන? We have to subject this r. කොහොමද අපි කරන්නේ? කොහොමද අපි කරන්නේ? දැන් මේකම අපිට ලියන්න පුළුවන් 61.2 equals to 84 divided by 1 plus r to the power 5. Now what I am doing, I am taking this 1 plus r to the power 5 like this. So 1 plus r to the power 5, it is 84 divided by 61.2. Now I need to remove this power 5. To remove this power 5, I am taking the square root. So here 1 plus r would be equal to 84, right? 84 divided by 61.2 like this. හරිනේ කතා? So 84 divided by 61.2. Okay. So here now I got 1 plus r is equal to 1.06. Right. Now I need to make r here. So r is equal to 1.06 minus 1. It is 0.06 as a percentage. It is 6%. As a percentage, it is 6%. As a percentage, it is 6%. So I got effective interest rate 6%. Please make a note of this. If anyone got a separate answer, please tell me. Sometimes there can be arithmetic issues. If anyone got a separate answer, please tell me. Okay. Then the next part, demonstrate using appropriate how this will be presented. No. So open imbalance. Open imbalance at which date? 1st April 2024, which is the initial carrying amount. It should be 60 plus 1.2. It is 61.2 million. 61.2 million. Then I have to add interest at effective interest rate 6%. So 61.2, right? 61.2 into 6%, it is 3.7. It is 3.7. Then payment or the receipt, nothing, no coupon, right? No coupon, no coupon. So closing balance at 31st March 2025, it is 64.9. Now out of these items, what is the impact to profit or loss? This effective interest should be recognized in P&L. So the double entry would be debit to financial asset, credit to P&L. Then this 64.9 should be recognized under non-current assets. Why? This will be matured after 4 years from today. So 4 years from today. Today here, today means 31st March 2025. So non-current assets, under non-current assets, you will have to report this in the statement of financial position. හදාගන්නෝක පොඩ්ඩක්. So when you have completed, please drop a message. Can you show before one also means the previous slide? This one. Interval 5 minutes. Okay. Right. Yes. Let's quickly take a 5 minutes break. Right. Let's quickly take a 5 minutes break. Starting from now, I am starting at 8:42. Okay, so time's up. We are back. Right, we are back. එහෙනම් නේද ළමයි? Okay, good. එහෙනම් අපි මේ ප්‍රශ්න බලමු. Question number 4. Question number 4. First one. Analyze whether Lanka Stay acts as principal or agent under SLFRS 15 revenue from contract with customers, considering the conditions of the agreement and customer expectations. Second one, based on your evaluation, determine how Lanka Stay should recognize revenue in accordance with the requirement of the standard. Okay, good. Write journal entries for Lanka Stay to correctly record the transaction under SLFRS 15. So we need to write the ledger entries, journal entries to correctly record this transaction. Okay. Right. So let's read the question first. Lanka Stay Private Limited operates as an online booking agent. It's like booking.com, right? Booking.com. For Seabreeze Resorts Limited in Sri Lanka under the following terms in the agreement. Pricing control, Seabreeze Resorts retains full authority to set room rates. Commission, Lanka Stay earns a commission of 8% on each confirmed booking. Service responsibility is with Seabreeze, right? Customer expectation gets clearly understand that Seabreeze Resorts, not Lanka Stay, provides the accommodation service. On 10th February 2026, Lanka Stay confirmed a 3-night booking for a guest at a Seabreeze property. The details are as follows. Booking value 240,000. Current policy of Lanka Stay to recognize the full booking value as revenue at the time of the booking. Following the recent appointment of new finance director, he has requested the finance manager to evaluate whether Lanka Stay's current revenue recognition policy complies with SLFRS 15 revenue from contracts with customers. Okay. So now we are required to assess whether the Lanka Stay acts as a principal or agent. Now, if we go and recall our memory on SLFRS 15, this area, right? So how does it works? Now in this scenario, I will take this, okay? So Lanka Stay is here, right? Now we are in the point of view of Lanka Stay. We have Lanka Stay here. Then we have customers, who are the tourists, and then we have Seabreeze. Okay, right? So usually what happens? Customers should directly coordinate with the Seabreeze, and that's how the transaction should have happened. But now Seabreeze is using an intermediary called Lanka Stay before they connect with the customer. So Seabreeze is connecting with Lanka Stay and Lanka Stay is connecting with the customers. End of the day, right? Customers will be get treated by Seabreeze. Now the point is, we are required to assess whether Lanka Stay is a principal or agent. When assessing this one, as per SLFRS 15, right? As per SLFRS 15 B34, right? As per SLFRS 15 B34, we have to assess whether control of the goods and services are transferred to Lanka Stay. Okay, we have to assess whether control of the goods and services are transferred to Lanka Stay right? Before it is transferred to end customer. Before it is transferred to end customer, right? Before it is transferred to end customer. So this is what we have to assess. Now, goods and services are coming from Seabreeze. So we have to check whether those goods and services control are transferred to Lancaster before it goes to customers. So if the control of the goods and services are transferred to the customer, transferred to Lancaster, make a yes or not, right? He will be a principal. Lancaster will be a principal. If it becomes no, Lancaster will be an agent. So how are we going to assess this one? කොහොමද අපි assess කරන්නේ? Now we have few criteria, or we have few indicators mentioned in paragraph B37 of SLFRS 15 to assess whether the control is transferred to intermediary before it transferred to end customer or not. So we have to assess that. So when we are assessing that, right, when we are assessing that, as per paragraph B37, one of the main criteria is, right, one of the main criteria is who is primarily responsible, right? We have to check who is primarily responsible to provide goods and services. Who is primarily responsible to provide goods and services? We have to ask that. Then we have to ask who sets the price, right? Who sets the price? Then we have to check who bears the inventory risk. Who bears the inventory risk? Now in this scenario, as per the information given, pricing is controlled by Seabreeze, right? Pricing control is done by Seabreeze. Then the service responsibility, providing services, is the primary responsibility of Seabreeze. Service responsibility is with Seabreeze, right? Then the inventory risk, right? Inventory risk is beared by whom? Here Seabreeze. Why? They are the one who is providing reservation services and all other services, right? Again, customer satisfaction එක දෙන්නේ කවුද? Seabreeze. Customer satisfaction is given by Seabreeze. Therefore, here, right, customers are expecting Seabreeze to provide services, right? When they are providing services, if some issue happens, then the inventory risk is beared by again the Seabreeze. Therefore, my dear students, right, all these three items are done by Seabreeze. Therefore, Seabreeze would be, right? Therefore, Seabreeze would be the principal, right? Since those indicators are not present, Lancaster will be the agent. Lancaster will be the agent. Now, when Lancaster becomes an agent, right, agent shall recognize revenue, which is the commission. Revenue is the commission. Revenue is the commission. But for the principal, revenue is the total booking value. Revenue is the total booking value plus any income that they generate from providing other services, hotel services and all. Right. So here, revenue is the total booking value for the Seabreeze, but for Lancaster, now we are in the point of view of Lancaster, right? We are in the point of view of Lancaster. In the point of view of Lancaster, he acts as an agent. So the revenue should be recognized on net basis as the commission. So for the first question, analyze whether Lancaster acts as a principal or agent. When you are writing the answer, you need to write this theory, right? You need to write the requirement mentioned in the standard. After that, you need to apply it like what I did here. Then you have to give a conclusion based on the above facts and circumstances. Lancaster do not get the control over the goods and services before it is transferred to the end customer. Therefore, Lancaster is an agent. Therefore, Lancaster is an agent. Right? This is the point. Liagan, make a note of this. I will give you 2 to 3 minutes. Is it clear, guys? Please drop a message. Is it clear? Okay, good. Better if it is clear. Total booking, is it including agent commission? So that you have misunderstood this one. Total booking value is the total value. ඒකෙන් percentage එකක් තමයි commission කියලා කියන්නේ. Right? එතකොට total booking එක ඇතුලේ agency commission තියනවා කියලා අපිට කියන්න බෑ. Right? So if it is 100, ඒ කීය වුණත් total booking value එක කීය වුණත් ඒකෙන් percentage එකක් දෙන්න ඕන. Right. So ඒකේ part B එකට answer එක ලියමු දැන්. Let's write the answer for part B. Based on your evaluation, determine how Lancaster should recognize revenue. Okay, so this is how they need to recognize revenue. Lancaster should recognize revenue as the commission income. As the commission income. So commission income should be 8% of the total booking value. It is 8% of the total booking value. Here it is 8%. 8% of the total booking value. Then you are required to write journal entries for Lancaster to correctly record the transaction. To correctly record the transaction. Now there is a transaction given in the question. Booking value, right? Booking value is 240,000. It is on 10th February 2026, right? So the booking value 240,000. So for this one we have to apply 8% rate. So the commission is can re-explain, but I think it will take a lot of time. In the interest of all, I'm not going to re-explain because we have to complete all entire paper. So kindly watch the recording when it is uploaded, right? So you see, not because of anything, it's because interest of time. Right. Here then 240,000 into 8%, 19,200, correct? 19,200. Now when we are recording this one, how this happens? Usually what happens is, right? Usually what happens is Lancaster is there and Seabreeze is here and we have the end customers now. This end customers will pay 240,000, right? So when they pay 240,000, Lancaster will recognize debit cash 240,000 credit payable to Seabreeze 240,000, right? Right. Then what they will do, they will transfer that 240,000 here and receive the commission, no? But that's an interesting question. The standard in these questions will definitely come in this structure in the paper. Yes, I would say yes. The critical standards are always be there in the exam paper, right? Then what they will do, they will have to pay this 240,000. So when they are paying to SB, they will deduct. They will deduct and pay. So they will deduct the commission, right? They will deduct the commission and settle it to SB. Therefore, right? Therefore, the double entry would be like this. Payable to SB, I am not booking the entire value, right? Payable to SB, මම මේ ඔක්කොම ටික book කරන්නේ ඇයි මම ඕකෙන් කෑල්ලක් revenue එක ඇතුළට දාගන්නවා which is 19,200. I will be paying only 220,800, right? I will be paying only 220,800, right? So this is how I would write the double entry. Done. Please drop a message after taking this down. Hope it is clear. Okay, good. So let's move on to the next question. It is from consolidated financial statements. Right. So definitely there will be a console question. Right. Definitely console question. අනිවාර්යෙන් ඔයාලට try කරන්න වෙනවා console question එකක්. So console නම් අතාරින්න එපා. Let's see. So this question is same. I mean, this theory question is same as per the pilot paper. I took it same because I thought it would be important. So explain the difference between control and significant influence from the applicable Sri Lanka accounting standards. So we have to differentiate between control and significant influence. Now guys, when we are differentiating control and significant influence, how are we required to do that? In the exam, if you get this type of a question, I would prefer, if I were you, I will be, right, I will be preparing a table like this, right? If I were you, I will be preparing a table like this, right? And here I will be putting control and here I will be putting significant influence. Significant influence. Then I am writing the answer in bullet forms, right? Okay. Should we prepare the FS4 entries to show? You mean you are asking that whether you need to provide the financial statement extracts? No, with regard to the previous question on writing the journal entries, their requirement is to write the JE. When the requirement is to write the JE, just write the double entry. That's enough. No need to provide financial statement extracts. Can we write answers in point form? Obviously, yes, depending on the time and depending on how powerful the point is. ඔයාලා ලොකු ඡේද ලියන්න ඕනේ නැහැ ළමයි. Right? Explain කරන එක explain the exact point. Okay, so here control. So guys, what does it mean by control? Now here මේ answer එක නෙමෙයි මම දෙන්නේ. I'm explaining, okay? If asked as accounting treatment, obviously then you have to write the rule first, then you have to apply, then you need to give the conclusion. That's the method you are required to follow. First write the rule, this is what's stated in the accounting standard, then you apply it to the scenario, then provide the accounting treatment conclusion. So let's say like this, X company go and invested in Y company, right? So X got more than 50% of the voting rights, plus X got the majority of directors. X got the majority of directors. Thereby they concluded that they can control Y. Now the problem is you are required to explain what does it mean by control, right? Right, control. So control means what? In which standard the control is defined? It is defined in SLFRS 10. As per SLFRS 10, control has three arms. One is the power to, right? Power to or else ability to direct. නැත්නම් power කියලා ගමුකෝ. One is the power, right? Power to make decisions. Then exposure to variable returns. Exposure to variable returns. Variable return means we are not getting a fixed return. Instead, when the business go up and down, you will get variable returns, right? If you are getting a fixed return, even the business is sinking down the sea, you will be getting that fixed income and you are happy, but the business is not happy. But when when you are exposed to variable returns, when the business is doing good, you will be getting a big income. When the business is doing bad, sometimes you will not get any income. That's called exposure to variable return. Then the third leg of this control is ability to use power to affect variable returns. To affect variable returns. Now, think if I have the majority of directors and if I have the majority of voting rights, I am using that power to take good decisions which are beneficial to the organization. So that good decisions will definitely lead, right? That good, that good decisions will definitely lead the organization to good profits. So if I do it better, I will be exposed to profit. So I am taking more and more good decisions. I am putting up there and my majority of directors are making up good decisions. So I am exposed to profit. ඒක තමයි මේක. If I do a blunder, what will happen? If I do a blunder, then you will be exposed to losses. It's same like active exam. Now, even if you study or not, if you are getting a good mark, then that is like you are exposed to a fixed return. But that's not the case. If you work well, you will pass. If you do not work well, you will definitely fail the exam. You are exposed to variable return, right? Then you have the power, right? You are the owner of you. So you have the power to take good decisions. Wake up early in the morning, stay late night and work hard. So if you do all this stuff, then you can affect, you can change your fate that you are going to fail, right? පැහැදිලිද concept එක? Exposure to variable return and the link. I hope it's clear. එහෙනම් this is what it is meant by control. Now, if one company gets the control of the other company, we can say investee is treated as a subsidiary. Investee is treated as a subsidiary and accounting treatment would be the consolidation. Accounting treatment would be consolidation, right? Accounting treatment would be consolidation. Okay. This is how the control is defined in the standard, right? Now, could you please help us to identify the target areas for the exam? Actually, not my ideas. Why? Because this is the first exam. No? It's really hard to find out target areas. So we can't do any guesses. So the best thing is to practice pilot paper and do the stuff. Okay. So otherwise I would have help, but I am also helpless in that point. Right. So now when we move on to the significant influence, here let's say X has gone and invested in Y. They have purchased 25% of voting rights. Then they can appoint, right? They can appoint directors. They can appoint directors, but not the majority. They can appoint directors but not the majority. That means when the director board come into the boardroom and start discussing about some new decision, these directors who appointed by X cannot themselves take decisions. ඒගොල්ලොන්ට විතරක් කතා වෙලා ඒගොල්ලොන්ට විතරක් කතා උස්සලා decision ගන්න බෑ. Right? They cannot themselves take decisions, but what they can do, they can provide insights, right? They can provide their thoughts, right? So that means what? That means what? They are providing insights and they are providing their thoughts. So this means that they are not making the decision, but they are participating in the decision making. They are participating in the decision making, right? They are participating in the decision making. So significant influence means what? Significant influence is power to participate, right? Power to participate in decision making. These decisions can be operational, finance, or invest in whatever, the business related decisions, but not to control, but not to control. Control karanna bෑ, they can participate. So the accounting treatment, the investee would be as identified as, investee is what? When we have the control, we identify the investee as a subsidiary. When we have significant influence, we identify the investee as what? කවුරු කියලාද අපි හඳුනගන්නේ? Associates. Very good. So investee is a associate. So the accounting treatment should be equity accounting. So investment in associate, this significant influence is defined in LKAS 28. LKAS 28. Right. Is it clear, Lamai? Is this table clear? Yes, of course you can get. Screenshot එකක් ගහගන්න ඉන්න තමයි එහෙම ලස්සනට ලියුවේ. This one. So here what I am telling is significant influence means power to participate. They can't take the decision on their own. What they can do is to provide insights. So if that is the case, the investee is identified as an associate. The accounting treatment is equity accounting as per LKAS 28. That's all. Okay, that's a nice request. So I'm going to cater that request. What is the third point in control? Ability to use power to affect variable returns. Ability to use power to affect variable returns. ඒකට තමයි මම අර උදාහරණ කිව්වේ. ඔයාට ඔයාව කන්ට්‍රෝල් කරන්න පුළුවන්. ඒතර ඔයා පාඩම් කරනවද නැද්ද කියන තීරණේ ඔයා කන්ට්‍රෝල් කරොත් ඔයා හොඳට පාඩම් කරොත් ඔයාට පාස් වෙන්න පුළුවන්. You are affecting the outcome, variable outcome by yourself. Okay, can you tell quickly and shortly how we can understand and identify which is subsidiary or joint venture or associate within a question? Of course. It's like this, right? When when one company go and invest in another company, right? If there is majority, right? First one, if there is majority of voting rights, right? Majority of voting rights. Majority of voting rights in the sense simply more than 50%. Sometimes even having below 50% shareholding, sometimes, for example, by way of de facto control, they will get the control. So I'm telling the most convenient and most common thing, right? So when we get the majority of voting rights, we say we get the control. So if we get the control, ඒ කියන්නේ 150කට වැඩිපුර shares invest කරලා තියෙනවා නම්, right? So if we get the control, then we treat that investee as a subsidiary. So we will treat investee as a subsidiary. Number two, if there is no control, then we need to assess whether there is joint control. To have the joint control, a mandatory requirement is there, which is unanimous consent. Which is unanimous consent. That means both the parties should come into one place in order to make the decision, right? In order to make the decision. So if that is the case, right? If that is the case, we identify this as a joint arrangement, right? We identify this as a joint arrangement. Then again, there are two types of joint arrangement. One is joint venture, other one is joint operations. The easiest way to identify joint venture and joint operation is when a new company is formed. When a new company is formed, ඒ කියන්නේ A සහ B එකතු වෙලා හදනවා shares දාලා C ව. Right? A සහ B shares දාලා හදනවා C ව. If that is the case, we identify C as a joint venture. Joint operation, no new company, A will put their assets, B will put their assets, then A and B together do the business. No any new company will be formed, right? No any new company will be formed. Then the third scenario, right? Then the third scenario, even if we do not have joint control, we check whether we have power to participate. Power to participate means we are having a shareholding between 20 to 50. If that is the case, we identify this as significant influence. We identify this as significant influence. That means this is an associate. Finally, even if we do not have significant influence, then we check whether the shareholding percentage is 20% or below. Right, 20% below. එහෙමනම් මේ තුනෙන් එකක්වත් නැහැ. No control, no joint control, no significant influence. එහෙම වුණොත් this type of an investment is identified as a financial asset under SLFRS 9. Financial asset under SLFRS 9. Shall we expect the final paper like mock paper? Please don't. Don't expect that because we can't say that. We don't know. Right. Yes. For the last question, it's yes. Hurry. Take a screenshot of this. Is this clear? If 20% it is associate or nothing. If it is 20%, yes, we are presuming it to be a associate. We are presuming. Joint venture and joint operation. So joint venture means the two shareholders, right? The two shareholders will form a new company. A put shares or else A puts money, B put money, and then they will form a new company called C. මේක තව ගොඩක් දේවල් තියෙනවා. හොඳේ මම මේ බේසික් ටික කියන්නේ. Then in joint operation, it's not like that. A new company will not be formed. Just A will put their own part of assets, B will put their own part of assets. Then without forming a new company, those two cumulatively do the business. This is financial asset. Last one, it is financial asset. JV means 50% shares of both companies. Most of the time, yes, but even it's not a mandatory requirement to have 50%. සමහර වෙලාවට 45 55 වෙන්නත් පුළුවන්. 45 55 වෙලා agreement එකේ තියෙනවා නම් both parties consent is required, then still be a joint venture. Shareholding percentage එකෙන් විතරක් we can't decide whether it is a subsidiary, associate or a joint venture. We have to look at other given information. That's what I explained. There are some unnecessary questions which I am not going to answer. Answering those questions will manipulate others' mind also. Right. Okay. Right. Done. Let's go for the question now. Now control එකයි significant influence එකයි අපි කතා කරා. Now we are moving to the question part 2. Demonstrate with required calculations how the acquisition of the additional 50% interest should be accounted for in accordance with the requirements of SLFRS 3 business combinations. Right? Accounting treatment for both JV and joint operation is not same. For the joint venture, we use equity method of accounting. For joint operation, we will consolidate our part. From others, our portion will be consolidated. Hope it's clear. For joint venture, we are using equity method of accounting. That is the most common type of arrangement which can be tested at the exam. Right. Then අපි යමු මේකට. Demonstrate with required calculation how the acquisition of additional 50%. බලමු කියවල ප්‍රශ්නේ. Horizon acquired 30% interest in Delta Spices on 1st April 2024 for 600 million, thereby obtaining significant influence. The investment was accounted for using the equity method. As at 31st March 2025, the carrying amount of the investment was 680 million. The carrying amount of the investment was 680 million. On 31st March 2025, Horizon acquired an additional 50% interest in DSL for 1,500 million, thereby obtaining the control in accordance with SLFRS 10. So the fair value of previously held interest is given, fair value of net assets is given, NCI is measured using proportionate share of net assets. Right. Okay. Now let's discuss that part. So this is step acquisition. This is a step acquisition. So step acquisition as per SLFRS 3, right? As per SLFRS 3, when there is a step acquisition, that means control is achieved in stages. Control is achieved in stages. Why we are telling that? As per the question, on 1st April 2024, they had invested in 30% interest. Therefore, it was a associate. Associate, a significant influence. Now what has happened? Right? Now what has happened? On 31st March 2025, they are obtaining an additional 50%. Now once they obtain the additional 50%, what will happen? The total shareholding will go up to 80%. Now having majority of voting rights, where all other information are silent, we can think now this is a subsidiary, right? This is subsidiary by getting control. So with this acquisition of additional 50%, control was established. Control was acquired. වැඩිපුර shares ගත්තකින් control එක ආවා. As per SLFRS 3, when you get the control over another organization, you are required to compute the goodwill. You are required to compute the goodwill. Why? Because, right, you are required to compute the goodwill. Why? Because from that point onwards, this is a subsidiary. This is a subsidiary. That means you need to apply acquisition accounting method. Acquisition accounting method in SLFRS 3, right? In SLFRS 3. So when you apply this acquisition accounting method, it's easy, not that difficult. Now you are getting additional 50%. For that, you will pay the fair value of consideration, right? You will pay the fair value of consideration to acquire 50%, right? Then from the date that you are getting the control, you will take the control of the entire organization. Even though you will have the right to 80% after this acquisition, ඔයාට අයිතිය තියෙන්නේ 80ක් විතරයි. හැබැයි ඔයා control කරන මුළු organization. You are controlling the entire organization and you will be consolidating the entire 100% of the balance sheet. You are consolidating the 100% of the balance sheet. Therefore, so you will be, for the purpose of goodwill computation, you will be considering the fair value of consideration. Then you will require to consider NCI, which is 20%. We have 80%, that means NCI 20%. Then එතකොට 70යි. අපේ කලින් තිබ්බ interest එක we had an interest. So we need to make it fair value. Fair value of previous interest. Fair value of previous interest. That interest is 30%. Now you can see altogether it is 100. Entire business එකේ කලින් අපි 30% වල ඉන්වෙස්ට් කරා. දැන් තව 50ක් ගත්තා. NCI ඉන්වෙස්ට් කරලා තියෙනවා 20ක්. ඕක මම compare කරනවා. I need to compare this with the fair value of identifiable net assets at the acquisition date. So this is the entire business. මේ බලන්න. දැන් හරිනේ උඩත් 100යි යටත් 100යි 100% to 100% compare කරනවා. That's how you are going to calculate the goodwill, right? Okay, so fair value of the consideration transferred to acquire additional 50% is 1500 million, right? Then fair value of the previously held interest is 760. NCI is measured using proportionate share of net asset method. So fair value of identifiable net assets is 2000. Now if I calculate NCI here, NCI should be 2000 into 20%, which is 400. Which is 400. Which is 400. Now you can see we have invested 80% and NCI have invested 20% in this business. So as a total, how much the total investment? It is 2660. Now the point, to get a business worth 2000, we have invested 2660. How much is the additional amount we have invested? Altogether 660. This is the invested amount for goodwill. So this part is the goodwill, right? This part is the goodwill. Then again here another thing is there which you need to be careful, right? We are taking the fair value of the previously held interest, but it had a book value, right? Carrying amount of previous interest, right? It had a book value. The carrying amount of the previously held interest at 31st March 2025 is 680, but we have a fair value of 760. So book value is 680, market value is 760. We have a fair value gain of 80. We have a fair value gain of 80. This need to be recorded in P&L. This need to be recorded in group P&L. This need to be recorded in group P&L. So this is the story, guys. When you are doing step acquisition, at the date of the control is acquired, we have to apply acquisition accounting method. Applying acquisition accounting method is computing the goodwill and accounting for the interest, right? Yeah, again. So is it clear? Is it clear? Please raise your hands and take it down. Once you have taken it down, please drop a message. Okay, good. I can see raised hands. Right. Yes, yes. Here it is fair value of previously held interest we have to take. I explained that, okay? Fair value, we have to take the fair value, not the carrying amount. 600 million is the original investment which we made on 1st April 2024. Now we are in 31st March 2025, so we have to get the fair value. Is it clear? Guys, is it clear? The person who asked this question. Okay. No, there is no any suggested solution booklet for the mock exam, but I will share sample answer only for the theory areas, not for the computations. Since there is no any suggested solution booklet, we are doing this session. There is no any chance to postpone the exams. Don't think like that. If you think like that, you will not be able to get yourself qualified. Qualified in 40 ගෙදර තමයි. Exam paper will be some kind of similar to the pilot paper. We also believe so, right? We also believe in that, right? Okay. I didn't tell my name, right? මම පටන් ගත්තට මම කවුද කියලාත් කිව්වේ නෑනේ මම ඒක අන්තිමට කියන්න. You might be wondering who is this new guy. So I'm not kind of a famous guy at CA. So you all might be wondering who this person is. But we'll see. Right. Now let's move on to section B. Question number 6. Section B, question number 6. You guys know me, right? From LinkedIn. Okay. So let's see this one. Question number 6, part A. Calculate the deferred tax balance and the related transactions to be reported in the financial statements of Sapphire Group as at 31st March 2026. Calculate the deferred tax balance and the related transactions to be reported in the financial statements of Sapphire Group as at 31st March 2026. Okay. So this is about deferred taxes. This is about deferred taxes. What I will do is I will quickly refresh the summary on how to identify the temporary differences. Then I will discuss the question. Right? So මේකේ ගොඩක් කට්ටිය පටල ගන්නේ temporary differences identification. Right. So okay. Now current taxes, right? Minus current taxes in the sense these are the taxes which we are payable on taxable profits, right? Which we are payable on taxable profits. So taxable profit is based on current year's income and expenses. But when we say deferred taxes, right? When we say deferred taxes, this deferred tax is future tax, right? Simple understanding is future tax. So when it is a future tax, this need to be based on future income and this need to be based on future expenses. Right. Now, my dears, when we have assets today, right, when we have assets today, these assets will generate future income. When we have liabilities today, these liabilities will create sometimes future income and will create sometimes future expenses. Therefore, future tax liabilities and future tax assets are created by our existing assets and liabilities. Therefore, when we are computing the deferred tax, we are using a balance sheet approach. Always we need to take assets and liabilities for the computation of deferred taxes. Now, simple thing is, when we say deferred taxes, we have deferred tax liability, right? We have deferred tax liability and we have deferred tax assets. If we have a future tax liability created due to this existing assets or liabilities, whatever, it will be a deferred tax liability. If we have a future tax recoverable, it is a deferred tax asset. A deferred tax liability is created due to the taxable temporary differences. When we multiply the taxable temporary differences using the tax rate, which currently 30%, we can arrive at the deferred tax liability. When we multiply deductible temporary differences, that means these temporary difference will be deductible in future when we are doing the tax computation in future. Taxable temporary differences means simply those differences, that difference will be taxed in future. Will be taxed in future. So when we have a deductible temporary difference, when we multiply it using 30% or the tax rate, we can get a deferred tax asset. And also deferred tax assets can be created by unused tax losses and unused tax credits. Unused tax credits. Hari. Now the problem is temporary differences, TD. Temporary difference occurs when the carrying amount of an asset or liability differs with their tax base. Carrying amount is the net book value or the net carrying amount as per Sri Lanka accounting standards. Tax base is in case if we prepare a statement of financial position as per the tax law, Inland Revenue Act. The value of the assets and liabilities in that balance sheet and also in LKS 12, this tax base is defined. I'm not going to that extent, right? So, in summary, right, in summary, we may have, right, assets and we may have liabilities, right? So, for an asset, tax base is, I am giving the simplest possible thing, right? Tax base is the future deductible amount, right? Tax base is the future deductible amount when we are doing the tax computation in future against the taxable income. අනේ taxable income එකට against අනාගතේ අඩු කරගන්න දෙන ටික. For a if it is for a PPE item, the capital allowances which we can deduct in future, right? Then for a liability, the tax base of a liability is future non-deductible amount, right? Future non-deductible. If it is an expense, it is not deductible, or if it is an income, what is future taxable? If it is an expense which is not deductible, if it is an income, right, which is future taxable, right? Now, having said that, there can be few scenarios. assets වල scenarios දෙකක් එන්න පුළුවන්, liabilities වල scenarios දෙකක් එන්න පුළුවන්. Carrying amount is higher than the tax base. Tax base is 1000, carrying amount is 1200. Now, when this asset will be converted into income in future, ideally we have to pay tax entirely on this 1200. But since we have a tax base of 1000, we can deduct that against this 1200. So we will have to pay tax only on 200. We will have to pay tax only on 200. So we will have to pay tax on that. Therefore, this is a taxable temporary difference. හරිනේ. ඊළඟට මේක අනිත් පැත්ත. We have a carrying amount of 1200 but we have a tax base of 1500. In future, we are expecting an income worth 1200 from this asset. So we have to pay tax on this 1200, but we can deduct 1500 as an allowed expense. Therefore, 1200 වලට tax ගෙවද්දී 1500 අඩු කරගන්න දෙනවා කියලා කියන්නේ it will create a future tax recoverability. Since it creates a future tax recoverability, we have a deductible temporary difference of 300. Then liability side, we have a carrying amount of 1200. The tax base of this is 1100. So ideally, right, ideally in future we will have to, right, in future we can deduct 1200 as an expenses, deductible expenses. We might be able to deduct 1200, but out of this 1200, the tax base 1100 cannot be deducted. tax base deduct කරගන්න බෑ. tax base එතන 1200ක් සාමාන්‍ය deduct කරගන්න පුළුවන්. ඒකෙන් 1100ක් deduct කරගන්න බෑ කියලා කියන්නේ අපි ගාව තියෙනවා 100ක් which can be deductible. So it's a deductible temporary difference. Deductible temporary difference. Then it goes other way around. Carrying amount 1200 and tax base 1600, right? Tax base 1600. So we have, let's say, a future income 1200 which can be deductible, right? Carrying amount එක deductible. හැබැයි tax base එක අපි කියනවා future deduct කරගන්න දෙන්නේ නැති ටික. ඒ දෙන්නේ නැති ටිකට අපි මොකද්ද කරන්න ඕන? tax ගෙවන්න ඕන. එහෙනම් 1200 deduct කරගන්න පුළුවන් තැනකදී 1600 deduct කරගන්න බෑ කියනවා. On net basis 400 cannot be deducted. So on that we will have to pay tax. On that we will have to pay tax. Right. So this is the summary. If the temporary, calculate the total temporary differences, apply the tax rate. If the net taxable temporary difference is there, you will have to recognize a deferred tax liability. If not, it would be a deferred tax asset. Please take a screenshot of this. Is it clear? I explained the reason. I'm not sure whether my speed hindered the explanation, but considering the interest of time, I quickly explained the reason, rationale. Right. Done. Now let's go and see the question. Sapphire Group PLC purchased machinery on 1st July 2025 at a cost of 50 million to improve the productivity of its tea factories. Sapphire Group's policy on non-current assets states that machinery of a similar nature should be depreciated over 4 years. The proposals on the tax amendment acts presented by the finance minister subsequent to the approval of the budget state that the corporate income tax rate will be reduced from the current rate of 30% to 24% of taxable profit. It is highly likely that this proposal will be enacted as they have won 2 rounds of voting in parliament in January 2026 with a solid majority. The current tax law provides a 50% capital allowance per year for machinery that improves the productivity of tea factories when calculating taxable profit for the year. Further, by the year end, gratuity provision of the employees amounted to 3 million. Gratuity provision was amounted to 3 million. Right. Okay. Just give it a try. try එකක් දෙන්න බලන්න. දැන් අර explain කරපු දේවල් එක්කලා identify කරගන්න. Right. Shall we do it? Shall we do it? Okay. So, we are required to calculate the carrying amount, tax base, then the temporary difference, then tax, then the deferred tax. The deferred tax. Okay. Right. So, first one, we have the machine. So, I am starting from machine. We have two items, machine and gratuity. Machine and gratuity. So, I am starting from the machine. So, they have purchased the machine. Working one on machine. They have purchased the machine on 1st July 2025. Our reporting date is 31st March 2026. That means how many months? It's 9 months. Am I correct? It's 9 months, right? The gap between purchase date and the reporting date. How many months? 9 months, yes. So it is 9 months. Now I need to take the carrying amount. The depreciation policy is to depreciate this kind of machines over 4 years. So carrying amount equals to cost 50 million less accumulated depreciation. It is 50 million divided by 4 years into 9 over 12. 9 over 12. So how much is the carrying amount? How much is the carrying amount? Yes, good. So 50 less accumulated depreciation, it is 40.625 million. This is the carrying amount. So I am taking carrying amount here 40.625. Then the tax base. So for the tax base, no proportionate in thing, right? For the tax base, no proportionate in thing. For the purchased year, full year, you can claim the capital allowance. For the full year, you can claim the capital allowance, right? So let's calculate the tax base. So we have the cost 50, right? Claimed capital allowance, it clearly say current tax law provides a 50% capital allowance for year 50% capital allowance ඒ කියන්නේ already 25 ගිහිල්ලා ඉවරයි තව ඉතුරු 25 විතරයි. This is the tax base. So tax base definition එකකින් ගියොත් future deductible amount is the tax base. So out of the cost we can deduct as capital allowances the remaining 25. So that 25 is the tax base. Now here you see, when we generate a future income of 40 million point 625, right? When we generate the income worth 40 million point 625, right? We have to pay tax on that. But since we can deduct 25, we do not need to pay tax on that 25. Therefore, we have a temporary difference of 15.625 which we have to pay tax at a rate. Now we need to identify that rate. As per LKS 12, right? As per LKS 12, the tax rate should be the rate. Yeah, correct. The tax rate should be the rate that we will have to pay in future, right? We will have to pay in future when this income is earned, right? When this income is earned. So that rate should be the enacted or substantially enacted rate. Now in this scenario, since the 24% rate is almost enacted, 2 rounds of voting completed, we have to use 24%. This is the substantially enacted rate. Therefore, from the day that this income will be generated, that income will be how got 15.625. That's the difference. Temporary difference is the difference between carrying amount and the tax base. That's what we have done, right? So substantially enacted rate we have to take. So I am taking 24% here. So we will have to identify whether this temporary difference is a taxable temporary difference or a deductible temporary difference. It is a taxable one. Why? Here 40 million point 625 we have to pay tax, but for that we do not need to pay tax on 25, but for the balance we have to pay. So this 15.625 is a taxable temporary difference. So it will create a deferred tax liability. It will create a deferred tax liability of 3.75. It will create a deferred tax liability of 3.75. Okay, done. Then we have a gratuity balance. So gratuity account in carrying amount is 3 million. Account in carrying amount is 3 million. So as per the current why 30% not taken, that's what explained. Why guys you are asking the same thing again and again, no? This is what I explained just now. We are taking the substantially enacted rate. We have to take the rate that the income will be generated in future, and at that time what would be the tax rate. That's what we have to take. So they are clearly mentioning that the tax rate 30 will be reduced to 24, right? 24, and already 2 voting rounds have completed. So it's the substantially enacted rate. That's why we are taking that. Okay. So gratuity, for the gratuity current tax treatment, right? For the gratuity current tax treatment is what? The gratuity provision is disallowed and the gratuity payment is allowed. The benefits paid is allowed. So here, when this gratuity liability entire 3 million, right? When this gratuity liability entire 3 million will be paid in future, this entire amount will be deductible for tax purposes. So for a liability, right, for a liability, future non-deductible amount is the tax base, but, right, but for the gratuity, entire 3 million is future deductible, therefore future non-deductible amount is 0. Future non-deductible amount is 0. That means we can deduct this entire 3 million, so it's a deductible temporary difference. It's a deductible temporary difference. We apply 24% rate. So it is 0.72. This is a deferred tax asset. So at 31st March 2026, this company has a net deferred tax liability. Has a net deferred tax liability of 3.03. Has a net deferred tax liability of 3.03. Right, done. Gratuity. So gratuity liability. Think on the current tax treatment. In the current tax treatment, gratuity provision will be disallowed and the payment is allowed. The thought process is, when we are paying this entire 3 million in future, we can deduct entire 3 million in future. So the tax base of a liability is future non-deductible amount. Future non-deductible amount is 0. Why? Entire amount can be deductible. So entire 3 million is deductible. So I am taking 3 million as a deductible temporary difference multiplied by 24%. It will create a deferred tax asset. Yes, we can offset if it is from the same tax jurisdiction and relating to the same entity, and if we are going to settle this on net basis. Right, done. Example of an expense that has a how we identified 4 years එක දීලා තියෙනවා question එකේ. The group's policy is in the first paragraph they have given. The group's policy is to depreciate similar nature items over 4 years. It's given in the question. Example of an expense that has a future non-tax deductible amount. Yeah, for the fines and penalties we can't deduct in future. It's a permanent difference, so we are not considering it for deferred tax computation. So I can give that example. Right, done. Console question, but I am not discussing. I mean, the question number 7 I am not discussing today, right? Question number 7 I am not discussing. It will be a separate question uh, discussed by Sandeep on 14th, right? So I'm not discussing that. So we have another kind of a question. Discuss how AI could be used to gain insights into financial and non-financial factors and their interconnections. I mean, what is asking? Yes, correct side. Your point is correct. Always we will have DT in FS if there is gratuity. Yes, of course. For tax base, can't we take capital allowances based on the months? Can't. Why? In Sri Lanka tax law, monthly capital allowances කියලා concept එකක් නැහැ. For the entire year that we purchase, we can claim full. Clear the ප්‍රශ්න තුනටම උත්තර දුන්න clear the. Right. For the next question, right? How AI could be used to gain insights into financial and non-financial factors and their interconnections. So how we can use AI? How we can use AI? Sorry guys. Sorry. So we may use now artificial intelligence. We may use DeepSeek, ChatGPT to do our market analysis, and even Claude AI is also a good option. We can use them to do market analysis. We can use them to do ratio analysis. Then even we can use Power BI dashboards kind of things to get real-time data, right? We can use AI to analyze our customers' behavioral patterns, right? How the customers are behaving, right? So likewise, those things you can think and write. So those things are creative and not confined into a box. So you can think and write. Hari, ඊළඟ එකට යමු. Next question. No, we can't have another session because other subject sessions are also going on, guys. That's the problem. Right. Let's see the requirement. Let's see the requirement. So even your question is not clear. Determine the position, right? Determine the position of the above three entities in the group financial statements of Sapphire Group as at 31st March 2025 with appropriate reasons. Determine the position, that means how they are need to be treated in group financial statements. Then calculate the relevant gains or losses to be reported in the financial statements of Sapphire Group parent, clearly specifying the related accounting treatment for each of the disposal above. Right. So no, it's not mandatory to take the standard books. Okay. So let's determine the positions. Let's read the question first. Sapphire Group has the following interests in the entities listed below. Sapphire Group has decided to dispose some of its interest in these entities with the aim of focusing on its main business segment, which is agriculture. First one, Sapphire Group sold 70% of its stake in Netcom PLC for a consideration of 820 million as at 31st March 2025. The fair value of the remaining 10% interest was assessed as 90 million on the same date. As at 31st March 2025, it was assessed that property belonging to Netcom PLC was impaired by 30 million. This impairment has not been reflected in the values presented in the table below. Okay. This impairment has not reflected in the values presented below. Okay. Right. ඊළඟට දැන් මෙතන මොකද වෙලා තියෙන්නේ අපි මේක පොඩ්ඩක් idea එක දාගෙන Sapphire Group sold 70% of its stake. දැනට කීයක් තියෙනවද මේ? දැනට තියෙන ප්‍රමාණයක් බලමු ඉස්සල්ලාම. 31st March 2025 they have Netcom PLC has 80% ownership, Built Right 70%, TSG Trophic Hotels Group 90%. හරි. Okay. එහෙනම් 80 වලින් 70% dispose කරනවා. 80 වලින් 70% dispose කරනවා. Okay. Then next one. Meanwhile, Sapphire Group sold 40% stake in Build Right, right? 40% stake in Build Right on 31st March 2025 to Crown PLC. Crown PLC already held a 20% stake in Build Right PLC. Through this acquisition, obtained control of the company by 65 rupees per share. The directors estimated that remaining 1.8 million, representing a 30% stake, could be sold at prevailing market price in the stock exchange, which is 55 rupees per share. After the sale, Sapphire Group can be represented on the board of Built Right PLC by appointing 2 directors out of 8. Okay. හරි. දැන් එහෙනම් අපි මේ වගේ පළවෙනි ප්‍රශ්නෙට උත්තරේ ලියන්න පුළුවන් the positions. First one, what has happened? We had 80 වලින් we disposed 70, right? So we are losing the control. You have to mention that Sapphire Group loses the control. Therefore, they need to stop consolidating Netcom PLC from 31st March 2025. From that day onwards, they need to account this investment as a financial asset. They need to account this investment as a financial asset. That is the position. Next one. Out of 70 in Built Right, they have disposed 40%. We have a remaining 30% stake and they are telling we have the 30% stake plus we can appoint 2 directors out of 8. 2 directors out of 8 can't make decisions, but they can participate in decision making. If they can participate in decision making, my dears, what does it imply? We don't have power to take the decisions, but we have power to participate. ඒකෙන් මොකද්ද කියවෙන්නේ? ඒකෙන් මොකද්ද කියවෙන්නේ? Significant influence. Very good. If it is significant influence, then it should be an associate. Then it should be an associate. Yes, good. Okay. Right. Then it should be an associate. So, what we have to mention? Here also, Sapphire Group loses the control and the 30% remaining interest should be accounted as an associate. This need to be accounted as an associate. That's the position. Third one. On the same day, Sapphire Group sold 35% of its total ownership of THG. We have 90% of Tropical Hotel Group. From that, we are removing 35%. Still, we are having 65%. Still, we are having 35%. And here, Sapphire Group also sold 35%. Then, with the aim of attracting market participants from Southeast Asia, the total consideration for above sale was 85 million. Previously, Sapphire Group appointed all 8 directors, but now Eastern Group appointing 2 directors. That means still out of 8 directors, we have the majority. So having the majority of directors, having majority of voting rights, we still have the control. Earlier also we had the control. Now also we are having the control. That means you need to mention that there is no loss of control. Therefore, this shall be accounted as a control to control scenario within equity, right? This need to be accounted as a control to control scenario. Why? We are still consolidating this financials and we have to account this as a equity transaction, right? We have to account this as a equity transaction. Okay. Right. That is the position. Position එක ලියනවා කියලා ඕක තමයි ලියන්න තියෙන්නේ. Then we have to calculate what? මේකේ second part එක. We have to calculate the relevant gains or losses to be reported in the financial statements. Hari. Okay, let's calculate the gains and losses. Right. Now when we are disposing, first one, Netcom PLC. Netcom PLC. So when we are disposing the interest, what will happen? We lose the control. So at the group level, we are required to calculate the disposal gain loss. At group level, we are required to calculate the disposal gain loss. So how to calculate the disposal gain loss? We have to first take, now since we are retaining an interest, we have to first take the fair value of retained interest. අයියේ අපි කීයක්ද මෙතන රිටේන් කරගන්නේ? මේ සිනාරියෝ එකේ නම් රිටේන් කරගන්නේ 110ක ඉන්වෙස්ට්මන්ට් එකක්. Fair value of retained interest. Then fair value of the sales proceed. We are selling, right? We are selling 70%. We are selling 70%. හරි. එතකොට තමයි අපිට කලින් තිබ්බ total ownership එක හැදෙන්නේ. We earlier had 80%. Guys, if we had 80% earlier, how much was there with NCI? If we had 80%, how much with NCI? 20%. Very good. It's 20%. Guys, give me a minute. Right. Okay. Yes, correct. It's 20% NCI. Now, we have to compare this, right? We have to compare. So, මෙතන එන්නේ අපි 80% interest එකනේ. We have to compare this with the interest of Sapphire over Netcom at disposal date. To get that, right, we take the carrying amount of net assets of that organization. Then if there is any goodwill, we add that, because inside this net assets the goodwill is not included. Then we remove non-controlling interest. Why? The carrying amount of the net asset is the 100% of the business. We only have an 80% interest. NCI interest is not our interest, so we are removing that. So carrying amount of the net assets of Netcom PLC 650, right? Goodwill 120, then value of NCI 130. Value of NCI 130. But there is a problem. We can't get it like this, Lamai. We can't get it like this. Why? Because there is an amendment need to be done. Why? I think you might have done this mistake, right? So, if you see, it clearly say, right? It clearly say there was a property which has been impaired by 30 million, which we had not considered, So, I will take here carrying amount of net assets before impairment. Before impairment, it is 650. Now, once we record the impairment, what will happen? Once we record the impairment, the net asset of the subsidiary, So, first of all, we are recording the impairment, right? We are recording the impairment. Okay, käällak අපිට අයිති, කෑල්ලක් NCI ට අයිති. So, impairment loss, right? This impairment loss, 80% goes to parent, 20% goes to NCI. Impairment loss is 30. So adjusted carrying amount is 620. So parents portion 24, NCI portion 6. Right? NCI portion 6. So the net asset value, yes, obviously will be reduced up to, right? Net asset value will be reduced up to 620, and the NCI value will be changed. The book value of the NCI is 130. From that, I need to remove this 6. Impairment record. So it is 124. So let's take the figure. Let's take the figure 620 plus 120 less 124. It is 616. It is 616. Now we need to get these figures. So the sales proceed, fair value of the consideration, right? For a consideration of 820, right? 820, and fair value of the remaining interest is 90. Fair value of the remaining interest is 90. Then again we have a fair value gain to calculate in that Y. Now here we take the fair value. Inside the books we have some value. We need to check whether the book value is higher than the fair value or not, and we have to identify that gain or loss also. So for the retained interest, right, for the retained interest, we have to take the carrying amount and the fair value. The fair value of the retained interest is 90 and carrying amount of the retained interest is 620 is the total value. Out of that it is 10%, which is 62. Which is 62. So we have a fair value gain. We have a fair value gain of 18, 28. We have a fair value gain of 28, which we need to record this in P&L. You need to mention this need to be recorded in P&L, which is the fair value gain on retained interest. Which is the fair value gain on retained interest. Right. හරි. දැන් අපිට calculate කරන්න පුළුවන්. Now we can calculate the disposal gain loss. Here it is 910. 910 less 616. It is 294. The disposal gain. 294. The disposal gain. This need to be reported in group retained earnings or else group profit. Group retained profits. P&L එක through end ඕන. P&L එක through end ඕන. Right. හදාගන්න බලන්න. Please drop a message after taking down. Then we can go for the next one. Done? Please drop a message. Yes, I will discuss question number 8 also. Okay, so let's move on to the next one. Netcom PLC hari. Before going for that, make it our. What is that? Now you you see in this question, there's a 45 million revaluation reserve. That 45 million revaluation reserve need to be transferred to retained earnings. 45 million revaluation reserve transfer to retained earning. Write that. Transfer to retained earning. You have to add it. Transfer to retained earning. Yes, done. Next one. Next one. Build right PLC. Build right PLC. So we had 70%. We are removing 40%. So we will be having only 30%. Right. From subsidiary to associate. The same thing. We have to get the fair value of retained interest. Then we have to get the fair value of sales proceed. Sales proceed. Then interest in build right at disposal date. At disposal date. So carrying amount of net assets plus any goodwill less non-controlling interest. So we are retaining 30%, selling 40%. So NCI, right? NCI before the sale was happened should be 30. අයියේ 70 කලින් තිබ්බේ. ඒතර 70ක් තිබ්බ කියලා කියන්නේ NCI 30. NCI 30. හරි. So we can take now build right. And Crown PLC has taken this 40 million, sorry, 40% of shares, right? 40% of shares by paying 65 rupees per share, and then the directors estimated that 1.8 million shares of this remaining interest. So remaining interest 1.8 million shares, market value per share is 55 rupees in the question. 55 rupees in the question. So fair value of the retained interest is 1.8 million into 55. It is 99 million. Now think, if 1.8 million is for 30%, how much it would be for the disposed 40%? So that means we are disposing 2.4 million shares at 65 rupees, right? At 65 rupees, that is 156. So altogether it is 255. The carrying amount of the net assets at the disposal date 270, goodwill 55, NCI 81. So 270 plus 55 less 81, it is 244. So we are giving the business worth 244 and we are getting 255. So 255 less 244, it is 11. This is the disposal gain. This is the disposal gain to be reported in group profit. This is the disposal gain to be reported in group profit. To be reported in group profit. Right. Okay, done. Then next one, the control to control scenario, THG. THG, it's a control to control scenario. In control to control scenario, how are we going to account? In this control to control scenario, you have to keep the point. Before we had how many shares? 90% shares we had. Then we dispose, right? Then we dispose how much? Then we dispose in this question 35%. That means after we are having 65%. After we are having 65%. That means guys, this is the holding percentage. This is the holding percentage. And the NCI, what happens? Before NCI is 10%, now the NCI balance is increasing by 35 to 45. So here it is not 65, it should be 55. Made a mistake. So here it is 40, 55. Now you can see in this scenario what happens is correct. I made a mistake there. So in this scenario what happens is the NCI increases. මේ බලන්නකෝ අපේ net asset වලින් ගැලවිලා NCI එක ඇතුළට මාරු වෙන එක තමයි වෙන්නේ. That's what happens. So NCI value, now let's take the values. NCI value, carrying value of the net asset is 180. So 180 into 10%, 18. Right? Then what happens? 180 into 45%, how much? 180 into 45%, it is 81. So the increase in NCI, is 63 million. Now we are giving 63 million net assets, right? We are giving 63 million net asset by way of increase in NCI. So to increase NCI, we need to credit NCI by 63 million. For that, we are receiving cash, how much? 85 million. So we are getting cash, debit to cash, 85 million. Now by giving 63 million, we are getting 85. That means we have a gain of how much? 22 million. This gain 22 million need to be credited to retained earnings. If not, other components of equity. Other components of equity. So no P&L impact like others, only a equity impact. Right. So this will be reported only within equity. This will be reported only within equity. Hari. This will be reported only within equity. Right, done. So any questions or clarifications before we move on to the next one? Question number 8. Any Clarifications, is this clear? I think this is something new to you because earlier syllabus this was not that tested. How the things are going on? Enjoying or sleepy or what? Little sleepy, no? 22 million goes to retained earnings. Directly we are crediting it to retained earnings. Hungry. I am also hungry. Here this is holding percentage. We are selling 35%. एक प्रश्न තියෙනවා. We are disposing 35%. We are disposing and giving that 35% to someone else who will become non-controlling interest. එතකොට NCI වැඩි වෙනවා. අපෙන් යනවා කියලා කියන්නේ අපෙන් ගැලවෙන ඔක්කොම යන්නේ කාටද? NCI ට. ඒක ඇල clearද? Yes, I will give a 5-minute break. I also need a 5-minute break. Yeah. So I was doing lectures today since 9 a.m. Now it's around 11 a.m. p.m. So it's a continuous day today. So yeah, it's okay. We will finish question number 8 and wind up the session. But before that, let's take a 5-minute break. Right. So now it's 10:41. Let's start around 10:47. A quick break. Right. Okay. Let's start. Hope I am audible to you. Anyone either? Okay. Right. So let's start. No, we can't say still because we only have the pilot paper. Some of the questions I can't answer. Right. Okay. Let's see. Apply the requirements of SLFRS 9 financial instruments to the investments acquired by the Treasury Department on the appropriate classification and measurement options. Appropriate classification and measurement options. Right? Okay. Zenith PLC is a diversified Sri Lankan conglomerate operating across manufacturing, logistics, healthcare, renewable energy, and real estate. The group treasury department centrally manages surplus cash, funding requirements, and investment portfolios of all subsidiaries. During the financial year ended 31st March 2025, the Treasury Department acquired the following financial assets. රේෂියෝ ගාන 14 වෙනිදා රෑට සංදීපස කතා කරනවා ළමයි සංදීපස ඩිස්කස් කරන්නේ ටික 14 රෑ 7ට පටන් ගන්නවා සෙෂන් එක රේෂියෝ එකයි කන්සෝල් දිග ප්‍රශ්නේ මම කන්සෝල් අනිත් ප්‍රශ්න ටික කතා කරා කන්සෝල් දිග ප්‍රශ්නේ ගාන හදන එක සර් කතා කරන්නේ okay right so we have to identify those financial assets so 5-year unquoted debenture 3-year treasury bond, equity shares, unit trust. Now let's quickly recall our memory on financial asset classification. Or else let's classify all financial instruments. Now let's see financial instrument classification. Financial instrument classification. When we say financial instruments, we have financial assets and we have financial liabilities. Within financial assets, we have financial assets on debt. We have financial assets created on equity. That means investment in shares and investment in debt instruments like bonds and debentures. Right. So, starting from financial asset on debt, right, we have to decide the classification of financial asset on debt based on two tests. We have to check for the SPPI test whether the contractual cash flows associated with that instrument is solely payment of principal and interest, and the business model So, the classification is like this. If SPPI is satisfied plus if the business model is whole to collect, right, SPPI satisfied plus if the business model is whole to collect, then we will classify that financial asset on debt at amortized cost. If SPPI is satisfied and the business model is whole to collect and sell, which means our objective will be satisfied by holding it until maturity and even collecting the contractual cash flows by selling, right? Then we will classify this at fair value through OCI. This fair value through OCI classification is with recycling option. With recycling option, which means the accumulated fair value gains and losses in the fair value reserve can be subsequently reclassified to statement of profit or loss upon disposal or derecognition. Then finally, if SPPI test is not satisfied O, right? Even if SPPI is satisfied, business model is any other business model. That means objective is to sell other business model, which means objective is to sell the financial asset. If that is the case, then we are classifying this at fair value through P&L. When we come to investment on equity, right, we have to check whether it is held for trading purpose or whether it is not held for trading purpose. If it is held for trading purpose, no option, it is at fair value through P&L. If it is not held for trading purpose, still we can classify it at fair value through P&L. This is the default classification. But if the financial asset on equity is not held for trading purpose, and if the organization irrevocably elect to classify at fair value through OCI, they can do that. This is an irrevocable election. This is an irrevocable election. Right? This is an irrevocable election. Right. හරිනේ මේ irrevocable election එකේ මෙතනත් FEOCI date එකෙත් FEOCI තියෙනවානේ මේ FEOCI එක without recycling, that means the accumulated fair value gains and losses inside the fair value reserve cannot be subsequently reclassified to profit or loss upon disposal. It has to be directly transferred within equity. කෙලින්ම equity එකෙන් transfer කරලා දාන්නයි තියෙන්නේ. Hari. Then for financial liabilities, the default classification is amortized cost. The default classification is amortized cost. But to reduce an accounting mismatch or for a derivative, we might use fair value through P&L in limited cases. This is in limited cases. Right? This is in limited cases. Right? This is the application. This is the summary. This is summary. Are we taking a screenshot? You need? You feel like it's important? SPPI means what are the contractual cash flows? Solely payment of principal and interest. That means our objective is to collect only principal amount invested and the interest accrued on that. HTC means hold to collect. Business model is hold to collect. This is not FUOCI, it's FV. V අකුර තමයි චුට්ටක් U වගේ ලියවිලා තියෙන්නේ. Fair value through OCI, fair value through P&L. Fair value කියන තමයි FV ලියන්නේ. Right. Now, let's go for the question. මොනවාද තියෙන්නේ? 5-year unquoted debenture, right? 5-year unquoted debenture. This is a financial asset on debt. This is a financial asset on debt, right? So this is issued by a listed entity at an interest rate reflecting the market rate for a similar counterparty risk. So this is a investment in debt. So we have to think on the business model and the SPPI, right? So here, first of all, we have to assess SPPI whether it is principal and interest. Now you see, we have the interest is reflecting the market interest rate, right? Interest is reflecting the market interest rate, right? So the instrument carries interest. හරි නෙමෙයි interest එක තියෙනවා ඊළඟට at the time of the derecognition we will get the principal. Other than principal and interest, there is no any disposal proceeds, there is no any premiums, there is no any non-cash benefits, there is no any conversion options, nothing, right? Therefore only principal and interest, and then, right, there is no any objective by the group treasury department to sell this at a good price within few years, right? There is no such objective. So there is no such objective to collect contractual cash flows by selling it, right? Therefore their objective as per the information is hold to collect. Therefore the classification should be amortized cost, right? So here SPPI test is satisfied and the business model is hold to collect, right? So it is at amortized cost. Then 3-year treasury bond purchased to meet the regulatory liquidity requirements of healthcare subsidiary. So we have purchased a bond to meet the regulatory liquidity requirement. Other than that, we do not have any intention to sell and collect contractual cash flows. So our business model is hold to collect, right? Business model is hold to collect what we had invested, and for that period we will get an interest. Therefore we do not receive any benefit other than principal and interest. We do not receive any benefit other than principal and interest, right? So here also hold to collect business model is there and SPPI is satisfied. Therefore this need to be classified at amortized cost. Reason, we do not expect any additional cash flow than principal and interest, and business model is hold to collect, no any intention to sell, no any intention to sell, right? Then next one, equity shares of a listed company, right? This equity shares is financial asset on equity. There is no any intention given. So when you are writing this one, you need to mention both the options. If it is held for trading purpose, then you need to say, if it is held for trading purpose, classification should be fair value through P&L. If it is not held for trading purpose, still they can classify it at fair value through P&L, right? But at the same time, this company can irrevocably elect to classify this equity investment in listed shares at fair value through OCI, which is an irrevocable election, right? Which is an irrevocable election. If that entity wish only, they are going to do that option, right? එහෙනම් මේක FVOCI FVPNL ඕන එකට දාන්න පුළුවන්. Why? Because still they have not mentioned the objective. If it is for trading purpose, then only fair value through P&L. If it is for non-trading purpose, then we can use both. ඊළඟට units in the ABC unit trust. Guys, these units are not full equity, are not full liabilities. Therefore generally it's kind of a mixed, right? Generally it's kind of a mixed instrument. Therefore these units are recognized at fair value through P and L. When you are writing the answer, you can mention units are kind of a mixed financial instrument, right? Where we get a fixed return, right? Where we get a fixed return. So we are classifying it at fair value through P and L. We are classifying it at fair value through P and L. Right. So the classification for the first one amortized cost, second one amortized cost, third one fair value through P and L if it is for trading purpose. If it's for not trading purpose, then again fair value through P and L or FVOCI depending on their election. Then for unit trust, fair value through P and L. So that is the application of classification and measurement options. Right, done. Next question. Advise the management on whether each of the real estate items should be recognized as investment property or property, plant and equipment in accordance with the standards. So let's quickly recall our memory, right? So okay. So when we say properties, right? When we say properties, it does mean by lands and buildings. Properties means lands and buildings, right? So depending on the use, right? Depending on the use or the purpose of holding, right? Depending on the use or the purpose of holding, we can classify them in different ways, right? If the property is owner occupied, that means if the owner himself using this asset, it is being used for the production of income or else for rental, not for rental purpose, production of income, owner occupied, right? So if it is owner occupied, then we will be accounting it as PPE under LKAS 16. If it is held for capital appreciation purpose, that means we have purchased the land and we are looking at until the value is increased. So capital appreciation or for rental purpose, if we are holding that for rental purpose, then this will be IP, investment property, under LKAS 40. Then if we are holding this two, right, held to sell in ordinary course of business, held to sell in ordinary course of business. So our general business activity is to sell lands and buildings, right? So real estate company, if so, this will be inventory. If so, this will be inventory, LKAS 2. Then we are holding this for sale, right? We are holding this for sale, but this is not in ordinary course of business. Earlier we used, now we are keeping it for sale. Held for sale, but not in ordinary course of business. Ordinary course of business. So in this type, we identify it as a non-current asset held for sale. Non-current asset held for sale under SLFRS 5. Under SLFRS 5. Right. So this is the summary relating to lands and buildings. Do we need a screenshot of this? Finds interesting? Right. Okay. Now let's go for the question. Let's go for the question. Zenith also operates a real estate and property development division managing commercial buildings and mixed-use developments in Colombo and Kandy. During the year, the division undertook several property-related transactions requiring assessment under Sri Lanka accounting standards. The following items were identified. First one, a newly completed office tower leased to third-party tenants under long-term operating leases. Guys, based on this, what is the purpose? What is the purpose? What is the purpose? Are we keeping it for own occupation or are we keeping it for rental purpose? Rental purpose. So we are giving it on long-term operating leases. Keep in your mind, if we are giving this on finance lease basis, then it will not be an investment property. Finance lease then it's not an investment property. Only if it is operating leases. So here, since it is held with an intention to rent it to tenants on long-term operating leases, this needs to be classified as investment property under LKAS 40, right? Under LKAS 40. Next one. A warehouse previously used by the manufacturing subsidiary now vacated and actively marketed for lease to external parties. A warehouse previously used by the manufacturing subsidiary now vacated and actively marketed for lease to external parties. මෙතන මොකද්ද වෙලා තියෙන්නේ? This property was previously used by the manufacturing subsidiary. That means earlier it was owner occupied. It was owner occupied. Now they have vacated. Their intention has changed. Now it is actively marketed to rent. Now rental purpose. What has happened? This is a change in use. As per LKS 40, keep in your mind, my dears, when there is such change in use, right? When there is such change in use, at the effective date of change in use, you need to transfer this from PPE to IP, right? So from the effective date of change in use, this need to be transferred from PPE to investment property, right? We need to transfer from PPE to investment property. When we are doing the transfer, you need to consider the accounting treatment. There are no sufficient information given in the question to tell the accounting treatment. Okay, because if it is a cost model to cost model transfer, accounting treatment is easy. But if it is fair value model, then again we will have to look at the classification, right? We will have to look at the classification. Right. So that's the point. Harine kata. Next one, land acquired for the future development of an office building with construction expected to commence in 2027, which Zenith intends to lease to its subsidiaries and earn rental income. Now, this land was acquired with an intention to develop the office building to rent it to third parties. Still, currently, at the moment, we have not yet started construction, but as per case 40, our intention, when we start the construction, our intention upon completion of the construction is to rent. එහෙනම් construction ඉවර වුණාම rent කරන්න යන්නේ. එහෙනම් අපේ purpose එක මොකද්ද? මේ land එක ගන්න purpose එක මොකද්ද? කවදා හරි දවසක අපි මේකේ බිල්ඩින් එකක් හදලා විකුණනවා 2027 නේ කවදා හරි දවසක කියන්නේ. So here even though currently we have not yet commenced the construction, our intention is to construct and rent it. Therefore this need to be treated as a investment property. Why? This is under development. Reason is this is under development for rental purpose. This is under development for rental purpose. This is under development for rental purpose. Right. ඊළඟට a hotel property operated by the group undergoing major structural renovations over 2-year refurbishment program. A hotel property operated by the group. The property is operated. Hotel එකේ business එක කරන්නේ එයාලා. It's not like that hotel property is rented out to a third party hotel manager. We are the one who is operating. That means owner occupied or rented. If we are the one who is operating, owner occupied or rented. Owner occupied. Now think, we have given our hotel property on rent basis to a third party hotel management company to run the hotel. If so, what will happen? If so, it will be rental. Why? Primary cash flows are generated from the rent income. So in that type of a scenario, you need to think from what the primary cash flows are generated. Is it from rental or is it from operating the hotel? Operating the hotel. Right. So here, since it is operated, this need to be recognized as PPE. Hari, ඒකත් ඉවරයි. Now we are moving to the last one. LCS 36. Interest in standard. Analyze the requirements of LCS 36 impairment of asset and advise the management on whether an impairment loss should be recognized for the CGU, the amount of any impairment loss, how that loss should be allocated to the assets of CGU, including the goodwill and the specialized machine. Right. Now if we recall our memory on LKS 36, right? LKS 36 impairment, right? Impairment means what? Not being able to recover the carrying amount. So how to identify this impairment loss? We are comparing the carrying amount with the recoverable amount. When the recoverable amount is lower than the carrying amount, that difference is identified as an impairment loss. This impairment loss can be identified for an individual asset, right? This can be identified for an individual asset, or this can be identified for group of assets. This can be identified for group of assets. So group of assets is considered as a cash generating unit, CGU. Right. Now here I am primarily focusing on CGU, okay? Now CGU is the smallest identifiable group of assets that can generate independent cash flows. So there can be CGU, right? Some CGU, for example a subsidiary, has an allocated goodwill. Some CGUs has an allocated goodwill. Some do not have an allocated goodwill. Some do not have an allocated goodwill. හරිද? ප්‍රශ්නයක් නැහැ. Some do not have an allocated goodwill. Okay. So if there is no goodwill, no issue. If there is goodwill, right? If there is goodwill, then we need to allocate the impairment loss, right? We need to allocate the impairment loss as per paragraph 104 and 105 of LKAS 36. This allocation need to be done like this. This allocation need to be done. First, we have to remove any out of scope asset. Any out of scope assets. For this, you have to refer paragraph 2 of LKS 36. That means there are certain assets which we can't apply impairment requirements in LKS 36. So if there are such assets, we can't consider that for impairment testing. So first of all, remove any out of scope assets. Then identify any obviously impaired assets. Any obviously එහෙම නැත්නම් specifically impaired assets. Obviously and specifically impaired assets. Right? Number three, right? Number three, we have to allocate impairment loss to goodwill. Allocate impairment loss to goodwill. We can write off it fully if we have impairment loss, sufficient losses. So can write off until 0. We can write off it until 0. After writing off even the goodwill until 0, if we have any remaining impairment loss, this need to be allocated among other assets on pro rata basis. Among other assets on pro rata basis. So this is critical, Lamai. This is kind of an important and examiner preferred area. So please be mindful on this. However, this is 104. Paragraph 105 කියනවා මෙහෙම. Right? When allocating this impairment loss here, මෙන්න මේ fourth step එකේ para 105 වල කියනවා when allocating this impairment loss, we cannot reduce individual carrying amount below individual recoverable amount of each asset. Let's say when we have 5 assets, right? When we allocate the impairment loss, some amount is calculated, but we can't allocate that entire amount. We have to limit it up to reducing the carrying amount up to the individual recoverable amount. ඒ asset එකේ individual recoverable amount එකටත් වඩා ඔයාට අඩු කරන්න බෑ මේ allocate වෙන impairment loss එකේ. එහෙම කරන්න බෑ. You have to limit it up to the individual recoverable amount of that asset. Right. This is the summary. Please ask if you have any doubts. Please ask if you have any doubts. For the last question, I don't have an answer. Right. Done? Have you taken down this one or have you taken a screenshot of this? Shall we move on? Okay, good. Right. Now, having this understanding, let's see මොනවද තියෙන ප්‍රශ්නේ කියලා බලමු ඉස්සෙල්ලා. Zenith Manufacturing Subsidiary operates a single integrated production plant that is treated as one cash generating unit. The plant produces packaging materials for the local market during the year ended 31st March 2025. The following circumstances arose. A competitor commissioned a larger, lower cost facility and the entry of cheaper imports significantly reduced the selling price and demand for the subsidiary's products. Management considers this as an indication of CGU may be impaired. Yes, as per LKAS 36, para 12, there are internal and external indicators. So this is kind of an external indicator, a competitor coming in and that competitor is providing goods at a cheaper cost. එතකොට මොකද වෙන්නේ? අපේ බඩු ගන්න කැමති නෑ, අපිට වඩා ලාභයට දෙන කට්ටිය ඉන්නවා, right? So it's an impairment indication. The carrying amount of the CGU's net assets at 31st March 2025 is 480 million, which includes of a goodwill 60 million arising on the acquisition of the subsidiary. So this 480 million, which includes goodwill 60 million arising on the acquisition of the subsidiary. Based on a recent offer from a property agent, the fair value of the CGU less cost of disposal is estimated at 395. So for the theory part, I missed one thing, how this recoverable amount is computed. Lamai, when we are trying to recover the carrying amount, we have two alternative options. Either we can sell it, right? Either we can sell today or either we can use it in remaining useful life. Either we can use it in remaining useful life. So if we sell it today, we can get the market value less cost of disposal. We can get the market value less cost of disposal. If we decide to use, right? If we decide to use, we can generate future cash flows. The present value of the future cash flows is the value in use. So as an economic decision maker, we will always go with the best option, highest benefit. Therefore, recoverable amount is the higher value out of fair value less cost to sell and value in use. It is the higher value of fair value less cost to sell and value in use. හරි. එහෙනම් මෙන්න මේකට අදාළව information දීලා තියෙනවා question එකේ. So they say fair value less cost to sell is 395 million. Then the management's 5-year cash flow forecast discounted at an appropriate pre-tax rate has a value in use of 410 million. Among the CGU's assets, there is a specialized molding machine carried at 90 million. Management is uncertain whether any impairment loss should be allocated to this machine if its individual recoverable amount can be reliably measured. Now what I told you? So first of all, we have to calculate the impairment of the CGU. Let's do that. අපි ඔය figures ටික අපේ අර template එකටම add කරමු. Let's add those figures into these templates, then it will be easy. Then it will be easy, right? So as per the question, right, as per the question, carrying amount of the net asset which includes goodwill, so that means 480 includes this goodwill 60 million, right? එහෙම තියෙන නිසා මම ඒක ඇතුලේ තියෙනවා කියලා ගන්නවා. So it is 480. Then we have a value in use of 410 million. Fair value less cost to sell 395 million. Tell me what is the recoverable amount? What is the recoverable amount? It is the value in use. We are always going with the best option. So recoverable amount is 410. Even though we have an asset worth 480, we can recover only 410. We can't recover 70. That we can't recover portion is what? That is our impairment loss. That is our impairment loss. That is our impairment loss. Now, we need to allocate this impairment loss. That is another point they are asking, right? That is another point they are asking. So this is the impairment loss we have to recognize. So how we need to recognize this one? First of all, we have to identify any out of scope asset. Nothing, no enough information, no current assets, no any obviously impaired asset. Instead, they have mentioned there is a specialized machine which the management think that if the individual recoverable amount can be measured, then they do not need to allocate impairment loss. That is not the case. That is wrong, right? We have to allocate an impairment loss if the individual assets carrying amount, individual assets recoverable amount is lower than the carrying amount. නිකම්ම recoverable amount එක හොයන්න පුළුවන් වුණ පළියට අපි impairment loss නොදා ඉන්නේ නෑ. recoverable amount එක individual asset එකේ හොයලා ඒක carrying amount එකට වඩා වැඩි නම් තමයි impairment loss එකක් නොදා ඉන්නේ. So when we are advising on that, we have to clearly mention just because that we are being able to compute the recoverable amount of the individual asset, we can't stay without allocating impairment loss. We can stay without allocating impairment loss only if, right, only if the individual assets recoverable amount is higher than the carrying amount. So that advice you have to mention. Then when we are allocating this impairment loss, we have a goodwill of 60 million. එහෙනම් අපි goodwill එක 0 වෙනකම්ම allocate කරනවා. 70න් 60ක්ම allocate කරනවා goodwill එකට. මේ එකක්වත් not applicable. මේ දෙකම not applicable. එතකොට goodwill එකට 60ක් allocate කරාම how much is the remaining impairment loss? Out of 70 we allocated 60 to goodwill. Now the goodwill is 0. How much is the remaining impairment loss? 10. You need to mention that remaining impairment loss 10 shall be allocated to what? Other assets on pro rata basis. Based on the information, that's all you can tell, right? You don't have enough information about what are the assets, so you have to mention the remaining 10 million impairment loss should be allocated among other assets on pro rata basis. On pro rata basis. Right. Clear? Is it clear? පැහැදිලිද? How about the others? There are around 96 people. Right. Okay. So my dears, as I said, there will be another session on 14th June from 7 p.m. conducted by Sandeep sir on question number 7. On question number 7. So I did not mention about me. I am Chandima Prabhat, right? So I am Chandima Prabhat, currently working as an audit manager at Ernst and Young, right? So I will show the previous slide. Give me a minute. So my dear students, now you have only 1 week remaining for your exam. So utilize this 1 week's time effectively and efficiently. Work kind of in a smart way. Don't try to look almost all the stuff from the study text A to Z. Now what you have to do is to focus on what are the mostly critical areas and focused on those critical areas and do critical study. So do a focus study this week and practice time in. Definitely it will be a hurdle this time because no MCQs to save time. You will have to write from start to end, right? Therefore time in would be a challenge. Make sure that you practice for the time in well. Okay, so I would love to hear feedback from you. Okay, so you might send me a feedback to one of these numbers, and even if you have any doubt, you may ask. Based on my time availability, I will respond, right? I'm not sure I will be able to respond at the same time you send the message, but I will try to respond at my earliest possible. So right, thank you, and keep a target to qualify. Uh, get yourself qualified as soon as possible. Just for some motivation. So I had a target to get qualified by 27, right? At the age of 27, but fortunately or unfortunately, I was able to complete my exams by 24, right? So became a member in 24. Therefore, uh, keep a target so you can capitalize that remaining years, right? You can capitalize that remaining years for your job and for your other well-being. Therefore, try, work hard and do your studies well. So those who want to take the screenshot, here is the slide. Others can leave. I would love to hear feedback, so better if you can drop a message with the feedback about the session. Thank you so much. Thank you for being with me around almost 4 hours, right? Almost 4 hours. So let's meet someday. Thank you. Good luck for your exams.